calm in the Treasury market equal gains in the stock market. Happy Friday, live from Studio 2 here at Bloomberg headquarters in New York. I'm Romaine Bostick.
And I'm Kaite Greifeld. We're kicking off the closing bell here in the U.S. And like Romaine mentioned, there is green on this screen behind me. You take a look at the S&P 500 up by 1.3%. That's actually a strong enough rally that we're positive on the week. Big tech, same story. The NASDAQ 100 up by almost 2% at this point. All of this while, again, volatility seems to leak away from the Treasury market. You take a look at the 10-year yield right now. It's pretty much unchanged. It was lower. Now it's come back, but all told, Treasury yield, the 10-year yield sitting at 4.62%. And I wanted to throw on Bitcoin just for fun. Of course, it's only up about 2% today, which is pretty small for Bitcoin, but we know it's been quite a rally in the digital asset space. Bitcoin above $37,000 a coin.
Pop quiz, Katie. What's the more volatile asset, Bitcoin or Treasuries? You don't have to answer that question. Of course, we know it's Treasuries, and the Treasury market, believe it or not, has been a bit subdued today as folks really tally up the damage from that cyber attack yesterday that prevented Industrial and Commercial Bank of China from clearing large swaths of Treasury trades. We now have a better sense, though, of just how much the market was actually disrupted by that. Daily total U.S. Treasury repo fails rose to $62 billion yesterday. To put that in perspective, that's more than double the $25 billion in fails that we had in the prior session. Now, that disruption was so bad that Bloomberg has learned that ICBC was forced to send trade settlement details by a messenger carrying a thumb drive. A lot of echoes of that ion trading hack back in January that paralyzed the global derivatives market and forced traders to revert back to pen and paper to keep track of settlement of their deals. Hopefully those we won't see a repeat of that today. Still some concerns, though, about the security of the financial system and some concerns out there today about the health of the advertising market. Ad buying platform Trade Desk, one of the biggest decliners here today, plunging more than 20% at one point after the company's earnings suggested economic pressures are damping spending from car companies as well as makers of consumer electronics on advertising. The report from Trade Desk coming a day after we heard from Warner Brothers Discovery, which said its advertising revenue in its traditional TV business was down 12% last quarter. We're going to discuss that story a little bit later today. But meanwhile, the latest consumer sentiment data is out from the University of Michigan, Katie, and it seems to suggest that inflation expectations are maybe starting to come a bit unanchored. Inflation expectations rising now. Yeah, both short-term and long-term. You take a look at one-year inflation expectations rising to 4.4%. Not quite the peaks that we saw in 2022, but still, as you can see, quite a jump up. But what's maybe more troubling, you look longer term, 5 to 10-year inflation expectations actually rising to 3.2%. That is quite the longest, I believe, since 2011, as Romaine said. But even still, even with this tick up in inflation expectations, you're not seeing too much drama in the bond market today. And we know that's coming off of the heels of a really big rally over the past several weeks. You compare that to what we're seeing in the equity market, that 12-month forward yield for the S&P 500. It had been whittling down the basically premium that equities enjoyed, but now you can see it's trended up a little bit as we see yields drop on bonds. We'll see whether this is really a break in that trend or basically just a hurdle on the path to negative territory. All right, let's kick things off to the close here with Melissa Fay, head of capital markets over at Drexel Hamilton. Pleased to have you here, Melissa, of course, on a day where we observe Veterans Day, officially November 11th here in the United States tomorrow. We should point out, of course, Drexel Hamilton, largely a veteran-owned and veteran-operated firm. I believe more than half your employees there have experience in the military. Is that correct?
That's right. Yeah, 65% of our employees served in the military, and really our mission is to help veterans who are interested in a career in finance transition into their civilian career.
And you, of course, you had your own career as a pilot, I believe, which is impressive. And now, of course, you're trying to sort of navigate, I guess, the skies of financial markets, which I don't know what's more dangerous right now, what's going on in financial markets or what's happening up in the air there. But kind of help us make sense here, I guess, of how you approach this just from your own sort of psychological level. When you have so much volatility in the market, you have so much uncertainty about what the next direction of the economy and what Fed conditions might be. How do you sort of tether yourself and keep yourself grounded?
Well, I think having been served in the military, and many of my colleagues have served in the military, we don't sweat the small stuff, right? And so if it's a rough day in the markets, you know, no one's going to die. It's going to be okay. And, you know, we just kind of rely on our training.
And that's probably a soothing message here after all of the volatility that we've seen in the past few weeks in the equity market, but really stemming from what we're seeing in the bond market. And now that we're past, of course, the Fed meeting, we're past the bulk of earnings season, how are you thinking about volatility going forward from here through the end of the year?
Sure. So I think, obviously we've had quite a solid November for equities. I think the S&P has been up 9 out of the past 10 sessions, except for the little blip yesterday, thanks to a dismal 30-year Treasury auction and also Jerome Powell's hawkish tilt to his comments. But, we're bouncing back today. And I kind of think really next week will be very telling, with the looming government shutdown and then with the 2 inflation numbers, CPI and PPI coming out next week. I think if they're in line with expectations, then we should hopefully be able to ride out the rest of the year with volatility continuing to stabilize.
Yeah, it's a good reminder that there's plenty of event risk coming up next week. Let's talk a little bit about what this has meant for the IPO market, because I was looking at some of the numbers say, obviously what we've seen this year is a little bit of a bounce back from the absolute dismal levels that we saw in 2022, but still we haven't really seen companies come to market and go public. How do you think that we fare in 2024?
Yeah, well, I think, obviously it's been very quiet this year. Just to put some numbers to that, 2021, that blockbuster year in equity capital markets, 400 regular way IPOs came to market to price about $140 billion. Year to date, 2023, we've only seen 96 regular way IPOs, to price about $19 billion. So, obviously I think everyone thought post-Labor Day we might see a pickup in the market. We haven't really seen that. We've only seen 9 regular way IPOs come over 100 million, and they haven't really performed that well. But I do think there's a healthy pipeline out there. And if inflation continues to stabilize and markets continue to stabilize, and continue to see clarity from the Fed on kind of a stop in the hike, I think we will see more healthier, talking to clients, first half of 2024 should be a pretty healthy pipeline.
But are you comfortable, and more importantly, do you think clients are comfortable with this new rate regime? The idea that even if the Fed is done, we're still looking at 5% rates roughly across the board here that might be here to stay for quite some time.
Yeah, it's interesting, kind of pivoting to the debt capital markets. Everyone right now is talking about what's the investment grade supply going to be in the debt capital markets. And really the expectations are about 1.1 trillion, which is what we've seen this year and similar to what we saw last year, even with that much higher interest rates.
And do you think, though, that at all, when we talk about that pipeline of potential deals that could come to market here, have some of them been lost forever? I mean, the idea here is that there were some people spooked by the volatility, but other people that were simply spooked also by the absolute level of yields. And if they don't come down, or at least the cost of capital doesn't come down, there's not going to be as much incentive for some of those companies to try to come to market.
That's a great point. I do think, just in talking to clients, in the private funding rounds of companies that potentially might go public, they're getting scrutinized a whole lot more. So that may mute volume. However, the companies that do decide to go public, I think, because the cost of capital is so much higher, investors are requiring a lot more scrutiny on those companies.
And we should point out, and I sort of laugh when you say that, because you point out that type of scrutiny, that was the norm for several years. It was called due diligence. And then, of course, in a zero-bound world, I guess all that gets thrown out the window. Right,
exactly. 2021 and free-for-all, right? Especially not even talking about the SPAC craze, but yeah.
All right, Melissa, it was great to catch up with you. You're going to have to leave it there. Melissa Fay, she's head of capital markets over at Drexel Hamilton. Her thoughts, of course, on the markets. And we should just point out once again, Drexel Hamilton, a majority owned and operated by veterans here in observance of Veterans Day here in the U.S., which is officially tomorrow, November 11th. We'll have a lot more coverage on Veterans Day, but in the meantime, we continue to kick you off to the close with a closer look at the latest on that hack that disrupted the world's biggest bank by assets and disrupted U.S. Treasury trades worldwide. That conversation coming up in just a bit.
Plus, Disney delays the latest versions of Deadpool, Captain America, and more. This is all following the settlement of the actors' strike, Romaine. We're going to get into what it means for the film industry.
And shares of Plug Power having an awful day. Remember, this is the hydrogen company issuing a warning about its ability to continue as a going concern. Is this specific to Plug Power or something broader going on in the renewable energy space? That conversation and so much more coming up in a bit on The Close. This is Bloomberg.
We haven't had something like this happen before. It seemed like the when issued market was okay going into it. There were a lot of questions because we've had such a big rally at the long end. You started to get the Powell comments, and then you got the hack, whatever that may have had to do with it. But we'd had such a big rally going into it after the 10-year went well and the 3-year went well. I think that had something to do with people stepping back.
Kathy Jones there talking about the hack over at Industrial and Commercial Bank of China. That is the world's biggest bank by assets, and effectively had to shut down a lot of its settlement of Treasury trades yesterday. Unable to clear those U.S. Treasury trades, and that actually forced employees to do it the old-fashioned way, putting everything on a USB stick and calling one of those couriers to, I guess, bicycle their way through the streets to wherever it needs to go. A spokesperson for the Treasury Department saying, quote, "We're aware of the cybersecurity issue and in regular contact with key financial sector participants." ICBC now conducting its own investigation. For a little bit more insight into where we are is Catharine Doherty, who covers this for us here at Bloomberg News. To say they're aware of the situation might be the understatement. I think we're all aware of it. I guess the question right now is, what have they done so far to, I guess, patch up whatever security flaw led to that hack?
So they've shut down their systems that were vulnerable to the attack to make sure that this did not spread. I think that was the first major concern. Not only did you see market participants, those that are investing in the marketplace, pull back and make sure that they were not getting impacted as a participant, but you also saw anyone that is connected to ICBC say, is our system going to be malfunctioning or vulnerable to a future attack in the same way? So ICBC came out and said that also its overseas operations and its New York branch specifically were not impacted. They had to really just reach out to customers and let the marketplace know, we have got this under control as much as we can. It's under investigation. We're trying to contain the risk by shutting off our software, and they won't turn that back on until all of this is sealed. Regulators are involved to make sure that they're patching up all of the potential holes that might leave even further vulnerabilities, because the worst thing that could happen is for this to get bigger than it is today.
Can we talk about the group behind this attack, Lockbit? Of course, it's a criminal gang with ties to Russia. It seems really industry agnostic, because you think about some of these other attacks that the group has orchestrated. I mean, Boeing, Ion Trading, the Royal Mail. It feels like it's casting a wide net, if you will.
It is, but it also it finds its corners. So earlier this year, they attacked a subsidiary of Ion, and that affected the derivatives market. We were reporting extensively on that. That was very much the corner of the finance industry that was very arcane and in many ways had systems that had been in place for so long that when they are not getting updated, that's when the vulnerabilities start to come through. I don't know as much about ICBC's system specifically that was under attack in this circumstance, but at the end of the day, after the investigation is finished, we might get some answers that also are tied to the lack of investment or needing to update certain software so that it's not open.
Is all this just on the shoulders of the individual companies and clearinghouses, or is there a more centralized approach to security?
So it's really, that comes down a lot to politics too. There's regulators that say we need to have strict rules in place to avoid putting the responsibility on certain parties. It even extends to, let's say you have third party or counterparty risk. So you might be able to regulate if you're a regulator, let's say it's the CFTC, you can say anyone that is a member, anyone that is regulated by the CFTC, you have to abide by strict rules that are meant to be protecting the industry. But a third party, so someone that is 2 steps away, that could be hacked or vulnerable to an attack, if their systems go down and then that sets off ripple effects in the market, it becomes a really complicated question.
Okay. And then just to be clear, yesterday they had to put all the stuff on thumb drives. And then was it like a bicycle messenger or something? Because I would think that would be, I think that would be less secure than the other option. Right?
I don't know if it's all bicycles.
You have to get these details.
Romaine.
These are the details I want to know,
And I also
Catherine.
would say that in the olden days when that was happening, that was because everything was in the tiny bottom corner of New York City, of Manhattan.
That's
and now
a good
you've
point.
got firms
They're
everywhere.
everywhere.
So I'm sure
you ever try to ride a bike across the Hudson River? It's
I'm sure
impossible.
there were USB drives going in lifts in the subway. Who knows? I don't know if it was all by bikes.
That was pedaling the bike. But Catherine, I know it's been a busy couple of days for you. Really appreciate your reporting. Our thanks to Bloomberg's Catherine Doherty. Now coming up, how the series of high-profile labor actions this year is getting Wall Street's attention, and of course what that means for investors. That's next. This is The Close on Bloomberg. Let's talk labor as 3 Las Vegas casino companies reach deals with the city's most powerful hospitality workers union, ending the threat of a strike in one of the nation's hottest tourist destinations. Now, these agreements come after Hollywood actors also reached a tentative deal. And actually, Wall Street is talking about organized labor more than ever. Mentions of strikes and unions on earnings call have surged. And joining us now is Bloomberg's Matt Townsend. And when we talk about this surge that we're seeing on these earnings calls, are you able to quantify that for us?
Yeah, so this year so far it's 80% above last year. And last year there was a huge bump. This year compared to 2 years ago, it's like a 3x jump. So yeah, one of the things Bloomberg can do is analyze a bunch of data. We looked at transcripts going back 20 years, and this year already is by far the biggest mentions of words like strike, labor negotiations, and union across, I think it's 81 companies in the S&P 500.
Has this sort of had a material impact, though, beyond just, I guess, the direct companies affected? I know we heard from some of the automakers who were very explicit about how much the strike actually cost them in that particular quarter here. But we know there were probably broader ramifications from these strikes as well, beyond just those companies.
Yeah, so there's, I mean, just in general, there's more questions from analysts about if you have a unionized labor force, what are the impacts there, but also to be directly and indirectly impacted. So think about the railroads, for example. They were talking a lot about the UAW strike because they ship a lot of cars. Airlines talking about the impact on flights into LA because of the actors and writers strike. So it just seems like there's more of a default sort of question about unions going forward because we've seen such a resurgence in the U.S. labor movement.
And I feel like it's an important note here that even though strike mentions have come up in certain cases, I mean, it's actually to sort of quiet things down, calm things down, and kind of walk back maybe some of the ripple effects.
Sure, yeah. I mean, UPS and FedEx are a good example. There was a big question mark about whether there would be strikes within their workforces. There weren't. But again, it's like, the labor movement for so many years, I mean, really decades, was on its back foot. Even where there were strikes, they were basically giving concessions. They weren't gaining a lot. Yeah. I mean, look at the UAW strike, just unbelievable, massive pay gains, benefit increases. Yeah. So this is a material impact going forward that I don't think, is really going to be going away anytime soon. Yeah,
pay gains, I guess, that the union would actually say were a little bit more commensurate with some of the profit gains from the previous years. Matt Townsend covering all this for us here at Bloomberg, and we want to continue the conversation about the impacts of these strikes. While some of them have been resolved, those lagged effects, if you will, still out there. Disney, we're learning, is delaying the release of its Deadpool and Captain America films. Other production companies are pushing, and in some cases even canceling the release dates altogether. Here, the impact of the actors and writers' strikes really have had that impact. Media and entertainment team leader Chris Palmieri joining us right now from Los Angeles to talk a little bit more about this. And let's start off first with Disney here, because they're just kind of shuffling things around, not necessarily canceling anything, but I'm curious that when you have such a prolonged period without your actors, without your writers here, how does that affect how these movie studios plan for these releases?
It's a huge challenge. This is really the third big schedule shakeup for Disney this year, and came after the actor strike settled. A movie like Deadpool 3 is just getting bumped a few months. That was half finished, and now they've got to scramble to finish it. They obviously couldn't work, when the actors were on strike. Some of these other films are being pushed as much as a year out or more. It's a game of dominoes. It's sort of, you move one movie to a different weekend. That's a weekend you've held for a couple of years. You got to move the weekend the movie you're going to release that weekend, and so it's a challenge for scheduling, and it's something Hollywood's going to be wrestling with for quite a few months at least.
And it's interesting, of course, to read about these delays. Of course, we heard from Disney this week reporting its results, and you take a look at the movie division, and it was pretty disappointing there. And when you think about these scheduling issues, Chris, or should we expect to see this come up in earnings calls, earnings reports for the time being?
Oh, absolutely. And you mentioned the Disney call. There's a whole lot going on as well. Bob Iger talked about he's cutting content spending on films and TV shows. About another $3 billion next year. The bigger picture too with Disney is that he's admitted that they were a little too aggressive, particularly on the Marvel side with all of the movies and TV shows, and you're starting to see a little bit of superhero fatigue. New movie The Marvels coming out this weekend is likely going to be the lowest.
Nobody's going to go see the Marvels. Come on. I mean, as soon as I saw that trailer, I was like, come on. I don't know what they're doing. I am curious, though. We shouldn't just pick on Disney here, because another interesting story, I think, is what David Zaslav's have been doing over at Warner Brothers Discovery. First, of course, he scuttled a couple of films, including Batgirl, and maybe that was because it truly was a bad movie. But then the latest news that they were scrapping this John Cena picture, which was kind of a live-action version of Wile E. Coyote, apparently in a court case against Acme or something. I don't know. The plot sounds incredible to me, but I'm curious as to why, for a finished product, something that was already filmed, already edited, why would they not just release it and try to recoup some of the costs?
That's been a big shocker at Warner Brothers. Originally, with the Batgirl story, there was some tax benefits they could get. Right, they did that right after the big merger that they acquired Warner Brothers Studio Discovery did. And so there was some benefits to just killing the movie outright. This much later in the game, more than a year later, it's obviously expensive to release a movie. That movie wasn't finished, so they had to spend tens of millions of dollars more, plus another 50, 60, $100 million to market and distribute it all around the world. So all of this is going in the equation, and Zaslav has certainly been probably the most aggressive cutter of things, even if they're in some cases finished.
Yet he's going forward with production of Cat in the Hat, and I seem to remember an earlier iteration of that. It was also probably one of the biggest bombs at the time. Chris, great to catch up with you. Chris Palmieri, that's a rhetorical question. Chris Palmieri, our man out in Los Angeles there, keeping an eye here, I guess, on what is now going to be the Hollywood studios restarting production.
I gotta say, Cat in the Hat, live action, that sounds like a horror movie. It sounds so scary.
I'm going to talk to Kaite during the break here about the last iteration of that. You might actually like it.
I don't know.
There are horses involved. This is Bloomberg. This is the countdown to the close, almost 2:30 here in New York. Stocks getting their mojo back here on this Friday afternoon. A bit of a mixed bag, though, right now in the commodity space. Abigail Doolittle standing by right now with our commodities close.
It is certainly a mixed bag, Romaine. Overall, we have some wide divide for some of these commodities here. And the Bloomberg Commodity Index itself is down in contrast to stocks. So we have this divergence for risk assets. Take a look at New York crude, though, a little bit of recovery from the recent selling, up almost 2% here on the day. But for the metals complex, that's where I really want to highlight some of the weakness. Take a look at copper, Dr. Copper, although I was reading recently, I think it was maybe in The Economist, saying that copper is maybe not the best tell on the global economy, having to do with some supply issues coming out of China. But in any case, down 1.2%. Gold, though, so you have the industrial metal of copper, but you also have these precious metals. Gold down 1.5%, and then take a look at palladium down 4%, continuing this year's big declines. Very quickly, let's take a look at the chart of oil, because a couple weeks ago we took a look at this chart, and it did suggest that a big directional move would happen. Now this chart that we had these trend lines drawn on, at that time it might not have seemed quite clear in terms of what was coming, but basically the sellers were getting ready to pounce. They have pounced. We have the update of today and a little bit of consolidation there, but the message of this chart, Romaine, is the sellers are getting getting ready to pounce once again. It might not happen next week, but it probably will happen over the next week or 2 weeks, maybe back below $70 per barrel.
Yeah, a wild week for crude oil, a wild week for some of the other commodities, particularly in the soft commodity space as well. And that's where we want to go right now and talk about food, the food sector and investments in that food sector. If you're in the private equity business, you need to find a way to stand out, and our next guests have done just that. It's a company called Butterfly. It's the largest food PE firm in the U.S. with more than $5 billion in assets under management. Its companies range from agriculture to aquaculture to food and beverage products, distribution, and services. Adam Waglay and Dustin Beck are the co-founders and co-CEOs of Butterfly. I'm pleased to say they join us from sunny Los Angeles, here in sunny but chilly New York. Great to have you guys here on this Friday afternoon. And we talk so much, guys, about this sort of idea of the future of food. And a lot of that has to do with sustainability. And I'll start with you, because there's this idea of whether we're putting enough effort and, more importantly, enough money and investment into that sustainable future.
Yeah, it's a great question. And I think it's on everyone's mind right now. A lot of investors want to make sure that impact is a very big theme going forward. And for us, we think we can do well by doing good. And I think we have a lot of deals where, consumers are willing to pay a premium for products and for services that they know have that kind of in mind. And so we just got a new fresh round of financing at Pacifico Aquaculture. It's a open ocean fish farming business that is the world's only producer of ocean-raised striped bass. And when you think about just carbon footprint and those types of inputs that I think investors and stakeholders and consumers are really focused on, that's where the future is heading.
You used the word premium pricing, and Adam, I will pose this question to you, because we spoke a few months ago back in Beverly Hills, and my question is kind of like, when I hear food and I hear some of the products and businesses that you're involved in, I can't help but think commodity or commoditization here. How do you sort of approach this from an investment perspective where you're going to have returns that aren't going to be commodity-like?
Yeah, Romaine, that's a great question. The only types of food investments we get behind are ones that have true pricing power. And the way we think about pricing power is either you're backing, a company that has something that's in limited supply, or something that's truly a phenomenal brand. And so we didn't know there was going to be global supply shocks. We didn't know there was going to be a pandemic, but we did get behind companies that ultimately had pricing power, and that served us well in this dynamic environment.
And I want to talk a little bit about the market backdrop and the exit strategies that exist right now, because we were just having a conversation earlier in the program about really the dearth of IPOs. And when you think about exit opportunities, which still exist out there? Are you looking at IPOs, or are you looking at M&A potentially?
Yeah, that's a great question as well, Katie. And one of the things Dustin and I are excited about is we're focused on the middle market in private equity. And what's beautiful about that is we have real exit optionality, we call it. We're really good at building companies to sell to strategics. Orgain, our protein powder business, we sold to Nestle as an example. We're also really good at building companies to sell to larger private equity funds, like where I came from, KKR, or Dustin, Vista. And then finally, we're not shy to take things public as well. I think the market today is a bit harder and more difficult, but we're able to navigate that too. So the main punchline for us is we want to have multiple ways to exit an investment.
And Dustin, I'm curious to hear your perspective. Of course, as we were just saying, the IPO market, it's a little bit challenged right now. What needs to happen for more of your portfolio companies to feel comfortable potentially thinking about going public?
Yeah, well, I think first and foremost, it starts with the consumer for us. We've been really excited by the strength of the consumer. I mean, there's a lot of negativity in what's around the corner, but for the most part, consumer has been quite resilient despite all of the kind of broader chaos in the market. And then I think for the right companies, there is still that opportunity. So Kava is a great example that we keep pointing to. They did a really phenomenal job. They just posted some unbelievable same-store sales growth, and I think the market's rewarded them. So for the right companies, investors will have an appetite to invest in those going forward. And then furthermore, a lot of the strategics, especially in food, have had some of the best years they've ever had. And so they're sitting on a large cash balance. And I think that is a nice kind of dynamic as we think about, do we sell a portfolio company to a strategic or do we go public? And with Orgain, for example, we'd filed our S1, we were ready to go, but Nestle made a great offer for us.
I'm curious, though, too. I mean, Adam was just talking about this idea of the strategics, of selling to other private equity firms. Was that always the original plan when Butterfly was founded, or were you looking for more of a traditional exit strategy through IPOs and other broader M&A?
Yeah, I think optionality is what you want, because ultimately you can't control the broader macro for a myriad of reasons. And so for us, getting to the middle market was really where we thought the sweet spot would be. And that flexibility that you have is really going to be compounded by the fact that if you have a really strong business, there's going to be exit optionality. And so, but I think mid-market amplifies that because you just have more routes to go.
How much competition have you seen, Adam, in this space here? I mean, this is still not, at least in terms of private capital, you're not seeing a whole lot of players in this space. Have you seen an increase at all in competition?
Yeah, that was one of the exciting things when we came up with this idea originally back at KKR. Food's a wildly successful space. It's a $24 trillion market that's been wildly successful for private equity, but there are not a lot of specialists. As you mentioned, we're one of the largest already, and there's just a handful of us. So the way we think about it is, it's sort of our area to own, along with a few select players. Now, some generalist private equity firms every now and then do food deals, so we see those folks show up every now and then. But in the eyes of the founders and the CEOs in food, we're thought of like a quasi-strategic, right? We're committed to the industry, we speak their language, and in a lot of cases, these founders and CEOs are rolling over with us into the deal. It's more of a partnership than an acquisition. And in those cases, they want to see who they're partnering with and make sure that that person's committed to the same industry, understands the same industry, and really can drive transformation, ultimately caterpillars into butterflies. It's the story behind the name.
I get it now. And we're talking about food. I gotta ask about weight loss drugs and GLP-1s. Of course, the Ozempic effect, if you will, has been mentioned. It feels like on so many different earnings calls across industries. When it comes to food investing and the type of investing that you do, is it something that you're thinking about? Has it changed your process or your mindset at all?
No, for sure. It'd be hard to not talk about it. I mean, the stats here are staggering. It's definitely something that we watch and we monitor. I'd say a couple of things. In our portfolio to date, we haven't seen as much of the effect. And I think, Katie, part of that is the types of companies that we've backed, more health and wellness oriented, more kind of high growth. Even if you're on those drugs and you're eating healthy things, we're just seeing less of that in our portfolio. But where the experts are projecting those numbers to go, we got to stay vigilant and on top of it. And I'd say, too, we have a lot of scientific advisory board type folks, nutritionists around the investments that we make, and there are some real concerns about these drugs as well. So we'll just have to stay close, see how we monitor it. And again, I think we're indexed less to customers that are really kind of taking those.
All right, guys, really enjoyed this conversation. Safe travels back to LA. Our thanks to Adam Waglay and Dustin Beck, the co-founders and co-CEOs of Butterfly. Now, still ahead, shares of Plug Power plunging after the company issues a warning about its ability to continue as a going concern. More on the pileup of analyst downgrades next. This is The Close on Bloomberg.
All right, let's get a view from the sell side with our top calls, big movers on the back of analyst recommendations. And we start off with Toast. It's the restaurant software company getting an upgrade over at Baird to outperform from neutral. The firm saying that Toast is one of the best of the potential gainers in market share in that industry and expect some strong revenue growth for years to come. The price target set at $18 a share. The shares higher by 1% on the day. Next, let's take a look at big box retailer BJ's getting an upgrade to buy over at Gordon Haskett, with that analyst saying that he's getting more constructive and is adding to its arsenal of more defensively postured retailers poised for upward earnings revision. Also seeing turnaround potential in 2024. Shares up fractionally on the day. And finally, let's take it one of the biggest decliners on the day, and that's Plug Power. Hit with a slew of analyst downgrades today after a really disappointing third quarter report. This is a company that makes machines that produces hydrogen and uses it as fuel. It issued a going concern warning amid worries about cash and liquidity. RBC Capital Markets among those lowering their outlook on the company, cutting its rating to sector perform due to the limited visibility. The shares down a whopping 44% on the day. And those are some of our top calls. let's stick with Plug Power here because I think we need to dive a little bit deeper into exactly what is going on with that stock and what is going on with the company. David Baker covers the renewable energy space for us here at Bloomberg. And David, give us a sense here as to when I hear this issue about a going concern, issues about cash and issues about liquidity, is this tied specifically to the company's spending, or is this more about broader industry-wide demand?
Well, there are a couple of things going on here, some which are particular to Plug, some of which are indicative of the whole industry. And I think it all boils down to essentially the growth phase that this industry is in. It's still pretty early on. With Plug, they have been going from one business model to another over the last 3 years. They, for years, basically sold fuel cell powered forklifts for warehouses and made a pretty good business out of it. But starting about 3 years ago, they started to get into the business of trying to produce hydrogen themselves, in part because they wanted to use it themselves, but they realized there might be an emerging market for it. So they bought out some companies to help them do that, and they launched on this program to build a bunch of production plants, both in the US and abroad. And some of those are about to come online, but they're not quite there yet. And they ran into a real problem this quarter because one of their main plants went offline for reasons they haven't quite specified yet. And they got into a crunch where they had to buy this stuff on the open market.
Yeah, and certainly a painful situation to be in. And when you think about that situation that Plug Power has found itself in, is there anything that we can extrapolate out to the broader clean energy space, or is this really just about Plug Power?
It isn't just about Plug Power, and I'd say this is really indicative of hydrogen. There are a lot of people out there who have big hopes for hydrogen as a future fuel because you can burn it and use it as a source of energy without producing greenhouse gases. But the problem is getting to that future is going to take a while, and it's going to be incredibly lumpy because in order to use hydrogen as a fuel, you have to have the equipment that can actually use it. You can't just drop it into something that already uses natural gas. And so with Plug, they're a bit better off than a lot of the companies in this space in that they use hydrogen themselves for those forklifts that they operate for their customers and that they sell to customers. So they have sort of their own built-in demand. But at the same time, ramping up both production and demand is going to be very uneven in years ahead.
What ends up being the balance here, David? Because, I mean, we're seeing a lot more investment in hydrogen, at least at the government level. And obviously, you have companies like Plug Power that have really tried to move the needle on the private side here. But there's sort of this balance now, or competition, if you will, between whether it's going to be an electric type of future, whether it's going to be nuclear, or whether it's going to be hydrogen or something else. Are they all kind of stealing from each other to a certain extent?
Not necessarily. They can all fit together pretty well. But again, it's going to be very uneven getting to that future. And nobody knows exactly what it's going to look like. So it's hard to place bets and make investments in it, both for individual investors, but also the companies in the space, too.
And so, David, I mean, I guess the simple question is where does Plug Power go? Is there any hope of coming out of this, or what's next for this company? What should we be watching for?
There are a couple of things to watch. They do have this plant in Tennessee that went down. They need to bring it back up. They've got another plant in Georgia that's about to open up, and everybody's watching to see if that does open smoothly. They've got another in Louisiana that's about to come online. But also, they're in line for a big federal government loan that they've been pursuing for a couple of years, and that would carry them through this crunch pretty neatly.
All right, David Baker out there on the West Coast there. A closer look at Plug Power having an awful day, down more than 40% on the back of its earnings and its going concern warning. Meanwhile, let's turn back to global politics and global relations here. The Treasury Secretary Janet Yellen, fresh off a meeting with their counterpart in China, they just met over in San Francisco, saying that discussions with China's Xi actually went well, said that they seek a healthy economic relationship between the U.S. and China. We should point out that Yellen also stresses that China and the U.S. are not seeking a decoupling. She also talked about the idea that global economic outlook still remains resilient, even though she did acknowledge significant risks to the global economy. So the readout here between the face-to-face meeting between these two is that further talks that will continue here. Relations maybe could potentially get better, and the broader economic conditions, of course, that serve as a backdrop, at least in her words, still remain resilient. A lot more coverage coming up here on the program. Stick with us. This is The Close on Bloomberg. All right, Saturday here in the United States is the official observance of Veterans Day, a time where we honor those who served our country. Bloomberg Business Week is out with some great reporting that explains why many veterans are now fighting for their homes. This after receiving a year-long mortgage break as part of a COVID-era program.
The one thing that they told us that they would guarantee us during our service, and that was to honor us, was completely obliterated in a mass haul to take homes. It made me feel forgotten to think that I had to seek legal representation to try to save something that I own. And it made me feel sad because I pass all these billboards, whether I'm going to drill or a training mission, it says, we will never forget. Support, help, honor the veteran. And the very basis of this country is to have a home, to issue all the freedom, and to live a happy and healthy life. And I'm not a war veteran. You know, there are plenty of people that have lost their legs, lost their lives, lost their sanity, and now they're losing their homes. So I feel lucky to even be able to share this story, but it's those who truly suffered after coming home who are still fighting every single day to keep themselves alive. And then on top of that, to have mortgage companies take the only thing that they have away from them, and that's a place to sleep at night and to call something their own. That's what it feels like to be actually forgotten and to know that you are forgotten.
Bloomberg's Polly Mossens is behind the reporting for Business Week magazine, and she joins us now. And Polly, give us some context here. How did this program come to be? What's the history of it?
Yeah, absolutely. So when the pandemic began, no one knew exactly what was going to happen to anyone's mortgage payments, not just that of veterans, but anyone in the United States. And Congress tried to account for that with the CARES Act, which did lots and lots of things to try to deal with the pandemic. And among them, it created this forbearance program that would effectively suspend mortgage payments while it was active for anybody. And among the 8.5 million Americans who took advantage of that program were about 500,000 service members and veterans in the United States.
So this gets to a broader question here, I guess, about why we didn't see maybe a little bit more assistance from the government, or at least more of a response from the government once it was clear that these foreclosures were starting to tick up.
I think that's also a question that a lot of veterans are asking, and the relatives of veterans and active service members as well. You know, I think that they had this idea that the VA would always be there for them. And while the VA has a large variety of resources, sometimes the veterans reported feeling like they had to reach out and they had to be proactive to find those resources rather than the VA being proactive. So I think that that's constant feedback that we were hearing from the folks who we interviewed, that they had anticipated there being more outreach from the government side rather than them having to seek help, be it through attorneys or through nonprofit groups. So that is a great question that I think many veterans were asking themselves and, you know, their fellow service members, especially in these social media groups where they were all communicating about the problem.
And Polly, there's a lot of great reporting in this piece. And as part of that reporting, I mean, when you brought this to the VA, when you brought this to the government, I mean, what was their response?
No, I think the VA is in a little bit of a difficult position. You know, they're not in charge of the lenders who are part of this system, but they are in charge of helping veterans. And the VA did walk us through a large variety of outreach services that they have in their loan counseling system. The VA also pointed out that, you know, it needs these non-bank mortgage lenders to allow them to run this VA lending system at all. About 80% or more of all VA loans right now are being gone through and passed through and underwritten by these non-bank mortgage lenders. So from the VA's perspective, they're doing what they can. They want to help people get into homes, but they also said that they really want to help people stay in homes. Yeah. And that's the challenge now, making sure that these vets get to stay in the homes that they purchase.
But are they pushing back on any of these lenders, Polly? Are they cutting them off? I mean, at the end of the day, these are effectively VA loans. They may not be issuing them, but it's pretty much an implicit guarantee that they're the ones backing them. So if you find either malfeasance or maybe just some sort of quirkiness going on right now in the way that these companies are handling it, why haven't they been cut off?
Yeah, that's a great question as well. So actually, one of the only pushbacks that we saw, it didn't come from the VA, it came from the CFPB and the DOJ. They sent a warning letter to mortgage servicers who they had received complaints about, but it didn't identify who those servicers were. So from the general public's perspective, even if the DOJ and CFPB reported being concerned about these business practices, they don't know if their mortgage servicer is one of those companies that the government is concerned about. So there's not a lot of information that's going all the way down to these veteran borrowers.
All right, Polly, really great reporting, really important piece. Really appreciate you joining us. That is Bloomberg's Polly Mossens. And meanwhile, Romaine, we are a little more than an hour away from close of trading on this Friday. You take a look at what's going on in the equity markets, and this rally is sustaining itself.
Yeah, sustaining itself, and now you're getting that retest of some of those key technical levels, including what everybody was looking at, which was, of course, that 4,400 level on the S&P 500, which is effectively the 100-day moving average, 4,406 on your screen right now, Katie Greifeld. So I guess we're above it.
Yes, so, and it probably helps that you're seeing a rally in the bond market as well. Much more coming up. This is The Close on Bloomberg.
Just about 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostick.
And I'm Katie Greifeld.
Stocks, of course, have been rallying all day long, and quite frankly, Katie, all week long. We had the blip yesterday where everybody said, oh, wow, the streak is over here, but back with a vengeance today with the S&P up more than 1%, the NASDAQ up more than 2%.
Yeah, this is really a big tech-led rally, and again, we've been talking about it. The quiet day in bonds probably helps. You take a look at the 10-year rate now. It's pretty much unchanged. It was much lower this morning. It's come back basically to just about flat on the day after we got that interesting, those inflation expectations out of the University of Michigan survey. Honestly, it was a little bit surprising to see inflation expectations tick up, but it really didn't make too much of a dent in the bond market.
Yeah, it didn't make too much of a dent here. We'll see if that changes next week when we do get that inflation data. You see palladium futures there down 4% on the day, 14% on the week, and that is directly tied to the softness that we've been seeing in EV adoption.
How does that translate to the crypto market?
I don't know how that translates to the crypto market, but at 37,000 and change, Katie Greifeld, are you dancing in the streets? Have you bought a new Lambo yet?
I am just an interested observer.
All right, flip up the board, because one thing I thought was interesting was T. Rowe Price was out with some interesting data about redemptions coming out of mutual funds here, basically saying that they are expecting to see clients withdraw more than $26 billion in the fourth quarter from their mutual funds. And this, as you know, Katie Greifeld, because you are the ETF queen, is largely because most people have abandoned mutual funds altogether and have switched into lower costs. And you can see this is the industry-wide, not just T. Rowe that you're looking at there, but you can see the outflows that we've seen on a month-to-month basis. Persistent, I think, is what that chart shows.
This is it's on track to be the 11th consecutive year where ETFs have taken in more money overall than mutual funds.
Yeah.
Ran those numbers earlier today, just for fun.
Okay, well, as you do.
as one does when you're concerned with asset management industry trends. But let's talk about some individual movers, because there's a few ones that we should take note of. Wynn Resorts, they reported after the close yesterday having a not too great Friday, down about 5.8%. That's after they reported third quarter Macau results that missed estimates, and that's really taking a dent out of the stock. As you can see, it did perform well when it came to Las Vegas, but kind of overshadowed here.
Have you been to Las Vegas and seen the Sphere thing?
Yes, I'm obsessed with it.
Yeah, you're obsessed with that?
Yeah, apparently they're looking for a new CEO,
Already?
I saw that in the poster somewhere, but let's move on. Let's talk about Illumina.
Are you putting your bid in? Is that what you're
I don't know, maybe teasing it, but we should talk about Illumina because it's also having a terrible day. Reporting earnings, giving soft guidance. You can see the disappointment in the shares rate there, down about 9%. They were down as much as 17%, so taking back some of those losses. And let's quickly talk about Warner Brothers Discovery. This news broke yesterday, actually, that Netflix and Warner Brothers Discovery's Max team are teaming up basically to offer a discounted streaming bundle.
Yeah.
Maybe that's working its way through the shares right now.
All right, well, one of the worst performers on the week as we move closer to those closing bells. Stick with us. Our cross-platform coverage of the day's top stories. That coverage starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Kaite Greifeld. We're joined right now by our colleagues Tim Stenovic and Jennifer Ryan, filling in today for Carol Massar. Welcome to our audiences across all of our Bloomberg platforms, television, radio, originals, and yes, Carol Massar. Those folks still streaming on YouTube. What did you do with Carol Massar, Tim Stenovic?
I don't actually know where she is.
Yeah,
she just didn't show up.
Yeah,
yesterday or today.
She's got a lot of clout at this company, right?
She can do whatever she wants.
Yeah.
But it's a little cold to be out on the yacht, so I hope she's wearing a sweater.
Don't worry, she's hopefully not watching or listening right now. I don't know. One thing that I know she loves to talk about, though, and we love to talk about here, are those GLP-1 drugs from the likes of Eli Lilly and Novo Nordisk. We're talking about Wegovy, Ozempic, and the most recently approved one.
Zepbound.
What did you say? Zepbound, yes.
Zepbound, yeah.
Rolls off the tongue.
Yeah.
So it turns out that employees are really interested in getting their companies to cover these drugs. I mean, they're very expensive. They range in price from about $900 a month up to over $1,100 a month. And the question is, are employers going to start paying for them at a time, Jennifer, when companies are, evolving what their benefits are looking like?
They're definitely always evolving their benefits and really looking for what employees are demanding. But I think what's interesting about this one, and this is what I'm trying to look into, is there's the potential for such healthcare cost savings with the reduction in obesity. So, I would think that calculus would play a very, very strong role in what companies are willing to shell out for this particular benefit.
Yeah, it would be nice, but of course we know a lot of companies don't always, do nice things. But maybe you can pair this up, Kaite Greifeld, with the work from, because remember the hot desking thing was such a problem here?
Yes, that was
I see a solution, Kaite, because I am about solution. And by the way, Kaite just threw her hat in the ring to be CEO of another company, by the way.
Which one?
Of the Sphere, the Las Vegas Sphere. Come on.
So this is your chance, Kaite Greifeld, to chart a path forward.
Is it because you just want to go to a U2 show? I mean, what's the deal?
I love it.
You love the whole Sphere?
The orb on the skyline.
Have you been?
No.
It looks pretty cool, doesn't it?
No, they don't actually let me leave the building, so I haven't made it out to the Sphere, but maybe one day when I'm CEO.
Okay.
Yeah.
There's another story too that I think we've been keeping our eyes on. It's not as sexy as Wegovy, Zepbound, and
what are you talking
whatever else
about?
thing. It's about closed-end mutual funds. Kaite Greifeld picked this story here, so why don't you go for it?
I picked this story because
Sizzle us with closed-end mutual funds.
I wrote this story, so I want to talk about it. Again, it doesn't sound too interesting on its face, but closed-end funds, if you take a look at the discounts that they're trading at, on average, really they've been dropping across the board, particularly when it comes to muni bond closed-end funds. And this is interesting because there's two types of investors in closed-end funds. Basically, you have retail investors who invest. Then you have people who invest in closed-end funds hoping for some sort of mean reversion of those discounts back to net asset value. And then there's the activists in closed-end funds. And that's where it gets really interesting. You're thinking about the likes of Boaz Weinstein over at Saba, for example. And basically, all of the activists and closed-end fund investors that we've been speaking to have been saying, this is a great time to pursue this strategy, to pursue mean reversion, or maybe invest alongside those activists right now because the discounts are quite wide.
So, Kaite, it's not often that we get to talk about a story that you actually wrote.
I'll talk to you anytime about a story that I've
So
written.
I'm going to use this as an opportunity to just interview you about it. I want to know how a story like this actually got on your radar.
I don't know if you know this, Tim, but I spend a lot of time on Twitter.com or X.
It's not called Twitter anymore.
Whatever you want to talk. But so does Boaz Weinstein, actually. So he's been tweeting about it. In March, he actually tweeted about a trade that he was planning to make. And basically, it came to fruition. And I've just been following him on Twitter. And then we started talking to some other investors in closed-end funds, and all came together.
I will say it is among the most read on the Bloomberg terminal today. But I have bad news. We're out of time to talk about closed-end mutual funds.
Nuts.
Yeah, I'm sorry. We're going to have to go.
Monday.
Don't worry, though, because we're going to be back together live on TV in less than an hour for our Beyond the Bell coverage. Not just on Bloomberg Radio and Bloomberg TV, but also, of course, on Bloomberg Originals and on YouTube. Don't miss it. It's coming up at 4 p.m. Wall Street time. We're going to take you through today's market close.
And we continue our coverage right here on The Close, counting you down to those bells with just a little more than 50 minutes ago to the end of the trading day and the week. And our next guest is all in on credit. Brandywine Global's Tracy Chen saying, quote, best performers year to date are floaters such as CLOs and CRTs, and that we continue to see great opportunities in the credit market where you can get to high single digit or low double digit yield without bearing
much credit risk. Tracy Chen joining us right now to talk a little bit more about that call here. It makes sense on paper, Tracy. Guide us through that here. Where are you finding those types of gains?
Hi, Romaine. Nice to see you again. Yes, I think in this cycle, household and corporations are in a better shape because they have been locking very low rate, especially when you look at mortgage borrowers. The average mortgage rate they have been locking in is a little over 3%. So much, much lower than the ongoing mortgage rate. And corporations, they have been able to term out their debt. So as a result, the balance sheet of both sectors are in a very good shape. So what we have been seeing, the levered up sector is actually the government sector. Mm-hmm. So this provide the credit investors like us great opportunities in many credit sectors. The first one is, I would say, the floaters, the floating rate CLOs and CRTs. But we also find the all-in yield in some short duration high yield, higher quality high yield, or lower quality IG corporate bond, very, very attractive. You don't need to take much credit risk to get a very attractive total return.
On that corporate side, we're talking about standalone debt, or is this backed by assets?
Backed by assets.
Oh,
yeah.
Gotcha. Okay.
And when it comes to basically when you're thinking about the credit market, think about other areas of the fixed income market, the treasury market, for example. How are you thinking about the relative attractiveness of credit to treasuries, for example?
So I think both are getting more and more attractive, and Treasury has been printing the third year of total return, the negative total return. So they are definitely look much more attractive. But in my view, I think you have to look at cyclical versus structural. So on a cyclical basis, probably we're close to the peak in interest rate. But on a structural basis, probably the rate will stay higher for longer. But on the total return base and the carry looks very, very attractive. But I think credit might offer a even better carry versus Treasury, especially if you look at Treasury. I think agency mortgage-backed securities probably offer a better return. So in our analysis, we shock the interest rate and see how the agency MBS will perform. We can see agency mortgage-backed securities can offer you like 100 basis point to 200 basis point extra excess return versus Treasury. If you think the spread will stay put and or the spread can even tighten from here, because the basis of agency MBS versus Treasury has been historical high.
Well, it kind of gets to something that I've been wondering. When you think about corporate credit right now, you mentioned all-in yields looking very attractive here. Is this a coupon clipping environment? Are you hoping maybe to see prices actually rally from here?
I think both. Coupon is definitely getting more attractive, but if you look at lower quality IG bonds, they are trading at a huge discount. So you definitely can get some capital gain from here as well.
All right, I'm curious too about kind of what we're seeing in the equity space, Tracy, and the correlations that we're seeing between the various asset classes right now. I know the correlation is pretty clear when it comes to the treasury market and the equity market, but when you fold in the other asset classes, what are we looking at right now? Where do those correlations stand?
Right. So traditionally, people like the 60-40 portfolio and the risk parity portfolio are based upon the negative correlation between equity and the bond market. But it's not always the case. When you do a dynamic study, you can see the relationship has been very dynamic. So in the 1970s to 1980s, where we witnessed hyperinflation, the correlation is actually positive. So if you forward to now, we're entering that positive correlation again. So if you use Treasury as a kind of safe haven hedge, probably you are less protected than before. So in our view, I think you have to look beyond U.S., look at global bond. Because the global bond market, each different country's DM versus EM, they are in different cycle, and also they offer different dynamic of fiscal and monetary policy. So by the global bond market and currency overlay probably will protect you even better than just using a U.S. Treasury bond market.
Have you found, I guess, some opportunity then, given those disparities that we're seeing on a country-to-country basis and currency-to-currency basis? Have you tried to take advantage of that yourself?
Yes, definitely. So as a firm, we have been very positive on LATAM, like local bond market, and the LATAM currency has been the best performer year to date. So because they have been like countries like Brazil and Mexico, they have been hiking rate earlier than the DM countries, and they are in a cutting cycle right now. So the local bond and also currency has been performing really well because of the interest rate cut. They are in the interest rate cut cycle.
Tracy, it's always great to talk to you. Really appreciate your time on this Friday. That is Tracy Chen. She is portfolio manager over at Brandywine Global. Now coming up, luxury under pressure as Richmond reports a surprise decline in earnings, what it means for the sector as high-end consumers rein in spending.
And Ken Moelis scrapping his plan to step down as CEO of his firm. Sorry, Katie, you're not getting that job. We're going to tell you what he has to say about why he's sticking around.
And the unique ways that the banking sector is fighting back against proposed new capital requirements. All that and more coming up. This is The Close on Bloomberg.
That more than week-long rally that we saw in U.S. equity markets put on pause on Thursday, but here on Friday, the switch has been flipped back on. A lot of green across the screen, including from all your favorites. Names like Amazon up 2% on the day, Apple up 2% on the day, Microsoft right now on pace for a close at a record high. Also, a lot of individual 52-week highs out there as well, including from Costco and a few others. The red on your screen really seems to be in more some of the defensive areas that had actually been the haven for a lot of folks, now moving out of those havens and into more growthier names. And S&P 500 up 1.4% on the day, 4406 and change right now here, and that is a good sign. A close above that level would put it back above its 100-day moving average and back above that psychologically important 4400 level, an uptrend sign that I think a lot of people are looking for. Meanwhile, as far as the rest of the asset classes out there, really a mixed bag. You're seeing a downdraft in gold once again here, a slight downdraft in the dollar, and oil trying to reassert itself after that big drop below 76 bucks a barrel earlier this week. Now back up about 2% here in the session to 77 and change. Let's bring in Abigail Doolittle, as we normally do around this time, for our Options Insight segment. Abigail, I feel like we haven't talked in a while here, so great to have you back here for Options Insight. And you're taking a look at small caps versus large caps and the wide divide on the week.
It really is, Romaine, because we have the S&P 500 at this point on this robust rally on this Friday, below average volume, but nonetheless big gains. The S&P 500 now up 1% on the week, a second up week, but the Russell 2000, it's down 3%. That said, off of its lows, at the lows down more than 4%, the worst week at that point since March. Kevin Kelly, CEO of Kelly ETFs, whenever I take a look at the Russell 2000 or think about small cap, and thanks so much for joining, I think back to 2007 when I was working for Hugh Johnson, and he was so upset by the fact that Russell 2000 small caps were breaking down. He was selling them out of the client portfolio, the IWM, and sure enough, a year later we had 2008. Now, I'm not saying that's the case now, but the small cap sector, that growth, that domestic bias, the banks often lead. So are you concerned by the fact that we have this big divergence, especially in this downward sloping range-bound trend for both indexes?
Well, there's not a big concern if you're investing in the S&P 500 with what's going on in the Russell 2000, and that's because if you actually put all the constituents together in the Russell 2000, they don't even equal one apple. And so they're not going to have a big movement or weight, when it comes to the overall economy, especially globally. Because if you think about the S&P 500, about 60% of the tech earnings within the S&P 500 come from globally, right? So, and the Russell 2000 is more of a U.S. and local story. And so when you think about the composition, 34% of the Russell 2000 is industrials and financials. And so it's just apples to oranges. And you can even see that play out through the fundamentals. If you just look at the PE, you've got the S&P 500 with a S&P 500 with a forward PE of about 19.2. And then you've got Russell 2000 about 22. it's playing out into the volatility markets as well. I mean, if you think about where is uncertainty, which is what volatility is, it's actually in the Russell 2000 and it's not in the S&P 500.
Well, that's what I would really like to ask you about. So it sounds like you think that the Russell 2000, even though it has led some prior sell-offs, that it's not too much of a concern here. But earlier this year, and you were so spot on bringing in the supermoons too, but the spread between the RVX, or excuse me, the VXN, the VIXN, and the VIX, that 5-point spread, you thought at that time it meant a reason because the NASDAQ 100 VIX was elevated that the S&P 500 volatility may go higher. So right now we have that RVX, Russell 2000 VIX at a 20 handle. We have the regular VIX at a 14 handle. My gosh, you don't think that it's a sign that that gap is going to compress to the upside for the VIX?
Yeah, and that's a great point because a lot of the NASDAQ constituents have huge weighting within the S&P 500. So when you're looking at the VXN and VIX, you can garner a lot of information, especially because tech was leadership. So you could say when tech sold off, it was going to take down the S&P 500. Not true for the RVX. You don't have overlap in the constituents. So that's the reason why.
That's very, very helpful in terms of explaining that gap. So what's an investor to do?
An investor should start looking at really companies that are shareholder friendly, that are looking to return free cash flow to their investors. And we've seen two companies talk about that recently. Qualcomm did it as well as Dell. Dell actually had their analyst day really recently, and they talked about how they want to return 80% of free cash flow to their shareholders via share buybacks and dividends. And so and that's up from 60%. And so, Dell's a great way to think about S&P 500 names that are shareholder friendly, that can diversify away from the Magnificent Seven.
Great perspective on small cap versus large cap. It sounds like you favor large cap, and it sounds like you might be just a little bit optimistic on markets. Kevin Kelly, CEO of Kelly ETFs, thanks for joining us for Options Insight today. And from New York, this is Bloomberg.
Bank lobbyists, they're coming to a football game near you. Lenders against the Basel III measure are dedicating millions of dollars to lobby against the Fed, with some actually running ads during NFL games to really spread the message far and wide. And it's interesting, again, this lobbying campaign. I don't know who necessarily they're trying to reach here, whether they think it's going to make a difference.
Yeah, I'm also confused by this as well. I actually saw one of these ads in the wild.
No,
it was like
really?
It was like a couple weeks ago or so. And
during a football game?
Yeah, I was just flipping channels and I came across it, and it kind of went in one ear. You know how you see something and it's like, okay, whatever. Then I thought about it and I was like, what?
Yeah.
Anyway, I guess if this is how they want to spend their money and they think it's an effective way to spend their money in the court of public opinion, I just don't know if the type of people who are watching football games are really the ones going to be making the decisions about whether these Basel III rules go through or not. But who knows?
I haven't actually seen the ad, but I did read the Bloomberg News article that described it. Basically, it showed hardworking Americans and basically warning that this is going to mean that they're going to pay higher costs for things.
They're trying to basically spin this as in that, look, you, the average person, are really the ones paying for this, and you should be outraged and I guess call your congressman or something to
just seems like a lot of steps to get there.
Yeah, a lot of steps to get there here, but this is good. I mean, we've been talking so much about all the weakness that we've been seeing in the advertising market. So maybe the fight over Basel III finalization, maybe that could be the salve
we're going to see
that boosts us back up.
Yeah, next earnings season, we're going to see companies mention that. I will say, though, that they did quote Aaron Klein in this article, who's a former U.S. Treasury official, currently at the Brookings Institution. He did say that the fact that they're running these against the Fed, it does really kind of undermine public trust in the Fed, which isn't great.
Undermine public trust in the Fed?
Yeah.
I guarantee you, can you just go out and do a survey? Just walk around America, real America, and ask how many people know who the Fed president is.
I'll do that over the weekend. This is The Close on Bloomberg.
This is the countdown to the close. Just about 30 minutes left to go here in the trading day and in the week, Katie Greifeld, and it is a pretty powerful week.
We are looking at close to session highs on the S&P 500, up about 1.5% right now. You take a look at the sector level. Look at this circle. It's all green. Almost every sector, every single sector in the green right now as we barrel towards the end of trading. You can see that big tech is leading the way. Information technology up 2.5%. Consumer discretionary not too far behind, up about 1.6%. Communication services, et cetera. You go down to the bottom of the list, the relative underperformers today. You have healthcare, you have consumer staples, you have utilities sort of underperforming here, which really tells you just how risk on this rally is.
Yeah, absolutely. We talk about the breadth of this rally as well. Of course, you have the big cap tech names like Apple doing their best to keep this market afloat. Apple up 2%. In fact, all of the Magnificent Seven having a pretty decent day. But Katie was just pointing it out here. This is a relatively broad-based rally. You have a lot of names out there doing well. Take a look at AutoZone, only up 1% on the day, but it's actually on its longest daily win streak in more than a decade here. Actually having, in fact, and as far as the Russell 1000, the biggest 1,000 stocks out there, this is actually the longest win streak out there right now for an individual name. Now, there is some softness in other parts of this market, and that is surrounding the travel sector, particularly when it comes to the airlines and those airlines that have high domestic exposure. JetBlue Airways down 1% on the day. American Airlines also down, an interesting downgrade as well from the sell side. Seems to suggest here that some of the strength that we had seen in some of those stocks earlier this year may be fading. And we've been talking a lot about the advertising space. Trade Desk down 16% here. Another pocket of softness in the economy out there right now, Katie. And I think people are also looking at another potential pocket, and that has to do with consumer spending.
Yeah, and that leads nicely to Swiss luxury company Richemont. It's under pressure after weaker than expected watch sales. The Cartier parent company experienced softening demand as consumers really push back against higher prices. Joining us now to break it down is Bloomberg Intelligence senior equity research analyst Mary Ross Gilbert. And you think about what we heard from Richemont. How does that stack out against what we've seen from some of its peers in the luxury industry as well?
Yeah, well, I think what we're seeing, there's probably a couple of different factors that are having an impact on the business. One, if you look at the charts and you look at sales and traffic, and we're tracking consumer transaction data. So when we look at, let's say, Saks Fifth Avenue, Neiman Marcus, and Bloomingdale's, if you look at the trend from sort of a peak period of very strong sales that were about 2 years ago in 2021, during that sort of easy money COVID boost, and now it's kind of trickled down. And I would say, we're getting back to more of a normalization. And then, with some of the spending that had occurred, unless you're in the Magnificent Seven, you might not be feeling as rich, let's say. But no, I think we're seeing a little bit of a softness in that they're still spending, and I think luxury is still strong. It's just at a lower level of strength because the consumer generally is being more methodical and more careful in their purchases. But clearly, so when you look at some of the watches, especially with Richemont, they have some of the highest end watches there, and the demand is still very strong. Yeah. I mean, some of the new releases that come out, they're going at a premium.
Well, let's talk a little bit about that because, I mean, there's been some debate here about the softness in demand that we're seeing there. And we heard something similar out of LVMH and some of the other, and Carrying as well, and even some of the luxury goods makers here in the U.S. here. But I'm wondering if this is purely just about demand in the sense that people feel like they don't need these items, but also the aggressive pricing that some of these companies have had for some of these new releases here. I mean, I know they're luxury goods, but some of the prices on these new luxury goods are even luxurious by luxurious standards.
Yeah, I would agree. The pricing has certainly gotten elevated. And I think what we've seen over the last year is you've seen the aspirational consumer, the one that got that extra boost from easy money and stimulus. They've definitely seen they've pulled back. So I think what you're left with are maybe the true luxury spenders. And also noted was the strength in China. And so even some of the buyers that buy for some of these very high-end consumers out of China, they will go to some of the other markets like in the U.S. and Europe, hunting down these very unique very pricey items. So I think there's still good demand for that, but I think in terms of being broad-based, it's not really broad-based. I think it's really, the top 5% or something like that.
So
that used to be top 1%.
Yeah. What does this mean, though, I guess, for kind of like the next tier down of retailers and goods makers, if you will, particularly here in the U.S., because we're kind of in that heart of the earnings season where we start to get a lot more of the apparel makers and retailers here in the U.S. And I know a lot of them aren't necessarily on the same level as a Gucci or a Cartier watch here, but they're still luxury and discretionary items.
That's right, there is. Well, what we've noticed with some of the retailers, for example, let's say Aritzia. Aritzia is not really well known, but 80% of their business is sold at full price, and they're that level down. You have, ultra luxe, luxury, let's say, then luxury, and then you have this other level, which they call everyday luxury, or I call it accessible luxury, and that's where Aritzia really fits in. And they're very tiny, Canadian-based company, but they're known for having fashion and quality that really aspires to the luxury labels. So with their consumer, they're still spending the same, but the traffic is down. So they're not shopping as much, but when they do, they're still spending the same. So we're seeing that. Now, if you sort of go down even further and you get down to the department stores, they're definitely seeing some weakness. And I think there's probably a couple of things going on there. One, general weakness with the consumer. The fact that if you look at the largest in the space, which is Macy's, half of their customer base within the Macy's brand, they make $75,000 and under, and they are still being adversely impacted by inflation, and they're spending a lot less. And I think another factor is last year with all those massive discounts that we had, there might have been some forward buying going on, maybe even on the higher end a little bit too. And so there might be some things in the wardrobe that still haven't been worn yet that is just making the crazy spending that we were seeing before not as necessary now.
Maybe a pull forward of demand, but I am curious how this breaks down on a geographic level. For example, how does the U.S. consumer right now compare to the Chinese consumer, for example?
Oh, well, I think it's very different. I think that the demand in China still remains very strong. We're seeing it with Ralph Lauren reporting their numbers. Their China business was up 20%. All of Asia was up 13% on a constant currency basis. And actually, Ralph Lauren, they keep raising their prices and but elevating the product. So it's not just about raising prices. It's a combination of they just keep moving up the scale, and they're kind of edging closer to an LVMH, let's say, and a Kering. So they're really moving up the luxury scale, and the consumer in that luxury space is loving Ralph Lauren. So they did see strength also in the U.S. But like I said, when you get down below that, the U.S. is definitely being impacted. We saw it with consumer confidence out this morning. So I think it's going to be interesting to see how the holidays fare. But we think the consumer will come out for the holidays, but they're focusing on bargains. That's going to be the number one driving force, and all the surveys indicate that.
Yeah, definitely an important season to watch. Really appreciate your time on this Friday. Our thanks to Mary Ross Gilbert of Bloomberg Intelligence. Now coming up, is Mark Zuckerberg's martial arts hobby a risk to investors?
What?
We'll discuss it next. This is The Close on Bloomberg. This is the countdown to the close. I'm Kaite Greifeld with Romaine Bostick, and joining us now is Scarlet Fu, maybe not.
Scarlet Fu is adjusting her microphone, so at some point
let me turn to you, Romaine Bostick.
Sure thing, right?
Yeah.
How's it going, Kaite Greifeld?
So far, it's good. I hope that we get Scarlet back because we're going to talk about newsmakers, people in the news. Maybe I'll just kick us off right now.
Yeah.
Wait,
kick us off right now.
Am I on now?
I don't know. You just have to speak very loudly, Scarlet.
It came back.
You can scream. Yeah,
I can scream. All right, so one newsmaker we're keeping an eye on, of course, is Ken Mullis, because he is ditching his plans of retirement. So another 65-year-old man who said he was going to step aside, and instead he's diving deeper. He's doubling down on his company and what he's doing. He's calling it one of the best opportunities right now to beef up his company's ranks.
A once-in-a-decade moment. How do you walk away from that?
I don't know, but I like Scarlet kind of hits on a point too. It's like, and this isn't just confined to, you know, the guys running Wall Street banks. You see this in sports. People just don't know when to just walk away.
Yeah.
I mean, you've had all the success. Just pass the baton to whoever you've trained.
Throw the football.
Throw the football, whatever other euphemism you want out there here. It'll be interesting to see what happens there. Another sort of figure in the news that I've been keeping my eye on is the co-founder of Prologis. This is the big warehouse company here. And Hamid Moghadam, he's basically the founder. He created a predecessor company, he kind of merged it with Prologis years ago, and it created this big thing. He's big on San Francisco. He's based out there. As you know, there's been so much talk about the decline of San Francisco and it's over. And he was very public. About a year ago, he was robbed at gunpoint. And he was very public about not only the trauma, but the lack of response by the city and the police. But he's also really optimistic. He's basically saying, I'm still committed to this city. And the best way to make it better is for me to stay here rather than just pack up and leave and go to Texas or Florida like everybody else here. And of course, this is against the backdrop of the big APEC summit where the city's really trying to spruce itself up because Xi Jinping and the rest of all these big Asian leaders are descending on the city next week.
And the Chinese media has really jumped on this idea that San Francisco has become kind of this criminal wasteland where everything is going to pot, and you know, they love that storyline. And of course, this is something that the business community is pushing back hard on.
Yeah, I mean, there's a group of 24 CEOs. They've contributed $25 million towards helping host this event. So it'll be interesting to see, of course, how that goes. But we have to talk about Mark Zuckerberg, the Meta CEO. He tore a ligament in a martial arts fight. He underwent surgery to repair it. And in his Instagram post on the incident, it's sparking memes, but it's also sparking a debate over whether this is something that needs to be disclosed formally to investors through filings or something like that, rather than just posting this photo on Instagram.
That he has dangerous hobbies?
Yeah, because you think about the key man risk. You raised this in the meeting we had this morning. You think about he's the CEO. He's also the controlling shareholder, which is a very important nuance.
Yeah, I was going to say the key man risk really isn't just about the CEO. It's about the idea that he has a stranglehold on any decisions that get made because of his voting preferences, voting shares, whatever you call it. But the idea here is that, I mean, we know that he was fighting, right? I mean, it wasn't a secret, so wasn't it kind of already out there? I mean, the fact that he had this mishap and tore his ligament.
I guess we just...
Did he tear his ligament on his own, or did someone else fighting him tear it? Because when they're in the cage, they're like grappling around, right?
Yeah.
And this is like, what does he do this for? Because he doesn't get enough stimulation from the billions of dollars that he makes?
This is why Elon Musk won't fight him, maybe.
Elon, you know why Elon Musk wouldn't fight him. I've seen Mark Zuckerberg without his shirt off. I've seen Elon Musk without his shirt off, too. So we know why that fight didn't happen. This is The Close on Bloomberg. This is the countdown to the close. Romaine Bostick here alongside Scarlet Fu, counting you down to those closing bells. And Scarlet, this is a really good day. I was just taking a look here. We're up about 1.5% on the S&P 500. But I thought this was interesting here. You think about the rally that we had coming in to start the week, 3 straight days of gains. I kind of missed this, but yesterday's decline wiped out all of those gains. So we were actually heading for a weekly loss until today, and now the 1.5% gain that we have on the day is pretty much your gain on the week.
Yeah, I mean, what this tells you is that we're basically following treasuries in every way. With the calmness in the treasury market, you could see the 10-year yield moving down marginally. Basically, it's not moving at all, 4.61%. You have equities getting a bit of a lift. If you make the argument that Powell said nothing different yesterday from November 1st, then today's rebound just more than recoups yesterday's sell-off. So the data that we got today doesn't show anything different. Consumers feeling worse than expected. Their inflation expectations running hotter.
Yeah, and we should point out that some of this moves today also somewhat technical driven as well, too. Because when we talk about some of those lines in the sand being breached to the upside, meaning
4,400,
4,400, the 100-day moving averages, and not just on the S&P, but on some of the other indices here, you start to get that momentum here. Now, of course, that also means you might necessarily get follow through next week. But at least for today, you get that pop.
There's also some follow through on Bitcoin, hovering around
Yeah.
$37,000. You told us yesterday how it's returned to its highest level since before the crypto crash in May of 2022, and it's building on that.
Building on that and the speculation, that drumbeat on these new ETFs really picking up. I don't know if you saw some of the reporting late yesterday out of CoinDesk here. Much more speculation that BlackRock is really committed to this, and the speculation that the SEC is going to have no choice.
Until the SEC says something, you know, we'll just continue to see the price move up.
Absolutely here. All right, let's kick things off to that closing bell here with Emily Roland, John Hancock Investment Management Co-Chief Investment Strategist, joining us right now. And Emily, I am curious about investor sentiment overall, really across asset classes, because for all the gloom and doom, I think, that we talk about here on the show, there does seem to be this bizarre willingness, this bizarre push higher on asset classes anytime there's some sort of break, I guess, in the clouds.
Yeah, sure. So this is the part of the cycle that we sort of consider the pivot party, if you will. There's a sense of relief amongst investors that the Fed is getting closer and closer to the end of its tightening cycle. You know, we saw Powell, of course, coming out a little bit hawkish yesterday, which caused some volatility across markets. But by and large, the bond market has not repriced for the expectations here for the Fed to remain on hold and then start cutting rates in July of 2024. So, you know, whenever there is this sense of relief that the Fed's getting close to being done, typically we do see move higher in risk assets, a lot of relief there. And I think that's really what's been driving markets.
I am curious about, we talk so much about the correlations and the negative correlation, I should say, that we've been seeing lately with treasuries and equities here, but we kind of forget about some of the correlations with other asset classes. And I was taking a look at the strength that we saw this week in the dollar, kind of a rare bout of strength, if you will. I think this is going to be like the strongest week that we've had really since early September here. And I'm wondering if investors should now start to put FX back on their radar.
Yeah, absolutely. You know, we think it makes a lot of sense to be leaning into the U.S. dollar here. It acts as a really nice diversifier when we're seeing weakness across both stocks and bonds. We're also looking at an environment where the U.S. economy, while we do think ultimately it will buckle in the face of the lagged impact of Fed tightening, it is no doubt holding up the best across global economies. And we've certainly seen that as of late in some of the business survey data. And the final kind of element here for the dollar is that it does tend to catch a bid in risk off environments. So if we do see an environment where global economic data contracts, of course, we've been talking about how that bad news has been good news for the market. But when we do see investors start to react to that, that also typically creates a bid for U.S. dollars. So, you know, we might not see the dollar go up, you know, in this sort of resounding fashion that we saw over certain pockets of last year, but we do think it'll catch a modest bid as we head into next year.
And of course, you can't talk about the rising dollar without looking at commodities that are priced in dollars. How does the recent swings in oil feed into sentiment? You look at WTI, for instance, at $91 a barrel in late September, and since then it's come way down. It's hovering around the $75, $77 a barrel. Has it gone from headwind to tailwind?
Yeah, it's definitely been, Scarlet, kind of part of the recipe that I think has given investors this sigh of relief that we're seeing right now. Again, lower rates, rates coming down. We've seen commodity prices coming down, even in the face of increased geopolitical conflict. You know, we think a lot of the decline in oil prices has really come from a decline in demand. So we often forget there's another side to the equation other than just supply. A few weeks ago, the EIA released a study suggesting that gasoline demand is now at a 22-year low. So we do see consumers starting to do the math on higher borrowing costs and potentially pulling away from those prices at the pump. So I do think, again, that's helped risk sentiment as of now, but we need to look at what it might mean going forward. And I think it's part of the puzzle as it relates to this global economic contraction that we're expecting.
Yeah, not to mention geopolitical headlines as well. Emily, talk a little bit about end of year portfolio adjustments that investors might be making or thinking about making, and how that dovetails with what's, you know, usually expected to be an end of year rally because of seasonal patterns.
Yes, a lot has been made of the Santa Claus rally at the same time that my kids seem to be furiously scribbling away at their Christmas lists. And I think we want to take seasonality with a bit of a grain of salt. I know that I'm a little bit scarred from what happened in the last 2 months of 2018. Investors were expecting this burst higher in risk assets as the midterm elections had concluded. And then, of course, Chair Powell comes out and says they're not even close to being done raising interest rates. And we saw how the market reacted to that. So seasonality can play a little bit of a role, but we think that where we are in the economic cycle and what the Fed does next are going to be the most important components to how stocks react from here. We still like higher quality equities. We're leaning into high quality bonds with a 5-6% income and looking at bonds as having the ability to do more heavy lifting in portfolios as we close out the year.
Do you think that change, that shift, that embrace of bonds that we saw this year, Emily, that is structural and that is lasting, that is going to remain a much larger component of portfolios going forward?
Well, look, I mean, we just asked a lot out of the equity market. I was just looking at earnings growth from 2021 through 2022, and we saw 37% earnings growth, explosive revenue growth from the S&P 500 as that $5 trillion of fiscal stimulus made its way into corporate profits. We also saw significant multiple expansion. We started this recent cycle with the S&P 500 trading at around 22 times forward earnings. So we pulled forward a lot from equities. Meanwhile, we've gotten just about nothing from bonds. In fact, we're staring down a potential third year in a row for negative returns on the aggregate bond index. That's something we've never seen. So I think looking at that 5-6% income, letting that work in portfolios suggests a modest overweight to fixed income.
All right, Emily, going to have to leave it there. Emily Roland over at John Hancock Investment Management, helping us count down to those closing bells and beyond. This is Bloomberg.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlet. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with our friends Tim Stenovic, Jennifer Ryan in today for Carol Master. Welcome to our audiences across all of our Bloomberg platforms as we count you down here to those closing bells, Tim. And this is a pretty good day here. 1.5% on the S&P, 2% on the NASDAQ. That big dip that we saw yesterday that had put that rally on pause, that's now a thing of the past.
Did everyone just forget about what Jay Powell said yesterday? I mean, is that what's happening here? I don't know.
Did he say anything different than what he said on November 1st?
No, but I think hawkish tilt is the term that a lot of people are going with. We did speak earlier to Rob Hayworth over at U.S. Bank Asset Management. He made a really interesting point about the companies that are doing the best today, the companies at the top of the S&P 500, the mega-cap tech companies. He said that shows that investors are still worried about higher rates for longer because they're buying companies that aren't necessarily relying on the debt market for funding for their future growth, so they won't necessarily be subject to those higher rates, Jennifer.
I know, and it's a very tricky calculus for a corporate treasurer because, you're kind of getting two different things. On the one hand, you had a little bit more dovish tone to the Fed minutes, and now we've got Powell and some other Fed officials coming out and trying to tamp back on that. But still, we've got to look ahead to retail sales. We've got inflation numbers next week, so that could help give a clearer picture.
Yeah, I was trying to take a look, too, at kind of just how much conviction was behind some of the moves that we've seen in equities. I mean, this is a broad-based rally on the day, but when you really add it up on a weekly basis here, you're really talking only about a third of the names in the S&P 500 are actually posting a gain on the week. Remember, those first 3 days of the week, even though we were in the green, there was relatively tepid gains here. So the strength that we're seeing here on this Friday really just kind of clawing us back, I think, to kind of where we were about a week ago. The Dow Jones Industrial Average is going to finish out the day higher, up by about 1% or about 390 points and change. The S&P 500 higher by about 68 points or 1.6%, and an official close above 4,400, 4,415 and change, which is also above that 100-day moving average. Meanwhile, the NASDAQ Composite higher by almost 300 points or 2% on the day. And for once, the Russell 2000 decides it actually wants to play along, up 1% on the day.
All right, well, this is pretty broad-based, at least in the S&P 500. Peeling back the layer there, Scarlet, you see 436 stocks in the S&P 500 higher today, only 65 moving lower. I feel bad for whoever's doing decliners, Scarlet.
Yeah, that'll be me later on.
Okay.
I look at the New York Stock Exchange, almost 3 stocks higher for everyone that is lower, and that is pretty much reflected in the industry groups as well. Chip companies are the best performers on the day and for the week as well, up about 5.5% this week. Software services and autos, that's really Tesla, bringing up the rear in terms of the best 3 performing groups. in terms of laggards, because all the industry groups are higher, food, beverage, and tobacco, telecom, and pharma. So the more traditional defensive sectors are not doing as well today.
All right, let's take a look at what's going on in terms of gainers today. I wanted to highlight Microsoft shares hitting an all-time high today, up 2.5%. The company having its best day, at least price-wise, highest price, going all the way back to 1984 when it IPO'd. Shares now trading at $369 or closing at $369.67 today. Let's talk about the best performer on a percentage basis. Microsoft on a points basis, the best performer. The best performer on a percentage basis today is Hologic, the diagnostic products company. It reported fourth quarter revenue and adjusted earnings per share that beat Wall Street's estimates. Investors sending shares of the company up by 7.3%. And then let's take a look at NVIDIA as well, because that company, among the mega cap tech companies that are leading the rally today, we saw Microsoft higher, we saw Apple, Amazon, Tesla, Meta Platforms, all among the biggest gainers on the S&P 500. NVIDIA finishing the day higher by close to 3%. It's now up for an 8th straight day. Sounds like a lot of days in a row, but weirdly, it's only its longest winning streak going back to March of this year.
All right, let's take a look at some of the decliners. It wasn't too hard to find because the ones that fell by a lot as investors continue to punish companies that don't do good, that don't make good on their forecasts. Illumina was the worst performer in the S&P 500 after the DNA sequencing company cut its full year sales and profit outlook for a second straight quarter, off by more than 8%. PowerPlug, the hydrogen producer, falling as much as 46%. That is the biggest drop in a decade. Investors questioning, or I should say Plug Power, investors now questioning whether the company can survive without additional funding after it issued a warning as a going concern. At least 5 analysts downgraded the stock afterwards. And Trade Desk, this is something that Romaine highlighted yesterday when we were looking at earnings. It's a digital advertising platform giving a fairly weak forecast for revenue this quarter, raising concern, of course, about the health of the ad market overall. The CEO said that Trade Desk saw reduced spending around cell phones, media, and entertainment starting in October, although it has recovered a little bit for this month. But we also saw declines in Snap and Pinterest, which rely on advertising sales, falling in response to what happened at Trade Desk.
Yeah, let's take a look at what's going on in the Treasury space, because, of course, we did see a lot of volatility on the week. On the day here, it was definitely a bit more subdued here. You take a look at the 2-year yield, which was higher by about 3 basis points on the day. But remember, on a weekly basis, we're about 21 basis points higher than where we were a week ago. Similar moves for the rest of the curve here, which actually shifted down on the day. That included a 10-year yield down just ever so slightly, your 20-year down just about 2 basis points, and your 30-year down by about 3 basis points. But once again here, I believe with the exception of the 30-year, all of the main points across the curve are higher on a weekly basis.
Yeah, I think the question that it brings up is sort of what happens next week, everyone. When we're thinking about what Jennifer said earlier, retail sales, we get a good idea of what the consumer is feeling and experiencing, because we got a couple important companies in the consumer space reporting next week. Walmart and Target are reporting, so we'll get a good idea of what Americans are spending their money on. And then, of course, we get the economic data next week when it comes to retail sales, Jennifer. That will help us get a good understanding of that too.
Yeah, it'll be an interesting one to watch, because especially where are they spending their money? Are they shifting more of their holiday spending towards the food and the stuff that really makes the traditional holiday? Is there going to be a lot of love for things like decorations, which aren't going to last the season?
Yeah.
A lot of what? Oh, that's blasphemy. You have to spend money on decorations. What's the point?
What, you recycle your decorations?
Well, sometimes, and we buy new ones. We're very festive in our household.
I don't doubt it.
Yeah.
I'm thinking
gotten
about
the invitation to the holiday party yet. It's so weird. I never get these invitations about these festive things.
He's always saying to check the mail.
Okay.
Home Depot is also reporting next week. So to Jennifer's point about what people are spending their money on, we know that during the pandemic, it was on your home and on everything related to freshening up your home, because suddenly people are spending 24 hours inside their home. But going forward, the big question is, if people aren't moving out of their homes and they're kind of stuck there because the housing market is frozen in place, how are they spending in that way?
Yeah, Scarlet, you can also buy Christmas decorations at Home Depot too.
Yes, you can.
And other sort of.
I thought they only
things.
sold skeletons that were like 10 stories high.
No.
They do Christmas
have you been to?
decorations too?
There's a Home Depot right next to Bloomberg World headquarters here.
I
You can
know.
do all your holiday shopping there. I guess depending on how much you love the person that you're shopping for here. But there's something for everybody.
Maybe a garbage disposal or something,
don't take
fire
advice. Don't get your
extinguisher,
wife anything
fun
for
gifts
Home
like
Depot.
that.
Bad idea.
Yeah, not a great idea.
Not that I'm speaking from experience.
Hey, we actually are interviewing the CEO of Butterball a little later in the program. program.
The turkey company?
Wow.
Yeah, the turkey company.
Okay.
Yeah. Do you guys know how much turkey prices have gone up?
Yes.
You do?
Yeah. Well, I mean, just anecdotally, yeah. I mean, at the store?
Well,
I don't know the percentage, Tim.
They're actually the same price last week that they were 1 year ago last week.
What?
Really?
According to the USDA.
Oh.
So a little bit of relief for consumers.
Are they giving
$1.14
away
a
free
pound.
turkeys this year? Because I remember last year, a lot of stores were using turkeys, either free or heavily discounted turkeys as kind of loss leaders to get people in the door.
Free turkey.
Yeah, free
I
turkey.
can't get my head around that.
Yeah, I don't know. I mean, nobody eats turkey any other time of year, so I don't know.
No,
why the
that's not
prices
true.
need to be
Cold
up.
Not
cuts.
true.
Cold
Yes.
cuts, right?
There we
Turkey
are. There we
sandwiches.
are.
I don't believe it.
$10.99 a pound.
I refuse to believe that anyone eats turkey outside of the holidays.
Romaine, you don't get out enough.
All right. So Romaine, when's that invitation coming to the holiday party?
There's some supply chain issues, Tim, but they will. I guarantee you, it's getting to you. Yeah.
All right. That's what happens. All right. Do we have to go?
I think so, Tim.
Okay. I think I'm being told.
This is normally when Carol does that, but she always forgets.
You know who else? We're also having some salted caramel whiskey on later.
Yeah, sorry, guys.
Of course.
What are you doing on radio? Is this what happens in November
The charm,
on radio?
Jennifer, you're sitting next to I mean, all they do is really just do wine and whiskey segments for that matter, and food
on
segments.
Fridays. It's kind of how it
and
works.
that's all it is. So you're just living the life of Riley over there.
Yeah. Well, don't tell anyone.
Yeah.
How does turkey pair well with this whiskey?
I don't know.
Yes.
They just give us tap water here on set, so we don't get any.
Pairs well with everything.
All right, guys, that is going to do it for Beyond the Bell, our cross-platform coverage of the market close on Bloomberg TV, on radio, on YouTube, and Bloomberg Originals. Meantime, catch us same time, same place on Monday. Have a great weekend, everyone.
And we continue our coverage right here on the close. Coming up here, a closer look here at U.S.-Chinese relations. President Biden and President Xi holding their first face-to-face conversation in more than a year. That's set to take place next week on the sidelines of the APEC summit. We're going to break down what those two men might actually discuss and whether anything might actually get resolved. That's coming up next on The Close. This is Bloomberg. The big sharp swings that we had on this Friday, really quite frankly, kind of fitting for the week that was here. We started off the week with modest gains on Monday, Tuesday, Wednesday. Those gains completely erased on Thursday, but, well, those gains now back here on the Friday. A 1.5% gain on the S&P 500 this Friday leads to a weekly gain of 1.3% here. The weekly numbers across the board are relatively good for U.S. equities, with the NASDAQ up 3%. Meanwhile, the Russell 2000, which did post a pretty solid gain on the day, about 1%, still down on the week by about 3%. A lot of concerns right now about some of those smaller and mid-cap names here and whether they have the fundamentals to justify any of the hype that you're seeing in the larger cap space. As far as some of the individual movers, believe it or not, one of the best performers on a weekly basis in the S&P 500 was a storage company, Extra Space Storage, up about 11%, while Illumina, the life sciences company, that was one of the biggest laggards in the S&P 500 this week, down about 16%. Meanwhile, two interesting moves in the commodity space. You saw WTI crude down on a weekly basis, down 4%, but on this Friday, it did try to reassert itself, gaining about 2% here, but still well below $80 a barrel. But remember, earlier this week, it was down around 75. And the slide that we saw in palladium futures this week is something we haven't seen in quite some time, a 14% drop. That's based on the back of some results that we got out of Rivian, Lucid, and some of the EV car makers that suggest that EV demand and EV adoption is slowing. And of course, palladium, one of the big ingredients that goes into those batteries. The yield story, of course, was also a story, and it will continue to be until the Fed says otherwise. 5% on the 2-year yield. We've been here before. It did cause a lot of consternation earlier here this week, but at least for today, even though the yield on the 2-year did tick up, Scarlet, here, investors, at least for right now, found some comfort in where we stand.
Yeah, it's nice to see a very little move in the U.S. Treasury market after what we've seen the previous few weeks. And of course, as we look ahead, next week is going to be really critical for U.S.-China relations, because Chinese President Xi Jinping will meet with President Biden on Wednesday in San Francisco for talks on trade, Taiwan, and other geopolitical issues. Both leaders will be among those attending the APEC summit. Today, of course, we had Treasury Secretary Janet Yellen wrapping up 2 days of meetings with Chinese Vice Premier He. They agreed to intensify communication, with Yellen now planning a visit to China next year. So let us bring in from Washington, Bloomberg's U.S. Treasury and Economic Policy reporter, Chris Condon. Chris, good to speak with you. Let me start with Yellen and He. Did they come to agreement on anything that's actionable for Xi Jinping and President Biden to move forward on?
No, I wouldn't say there were any dramatic agreements. We heard Yellen welcome the announcement last week that China made that it will accept the quota increase at the IMF. And in kind of in exchange for that, she's promising more substantive talks with China about quota reform at the IMF. That's important to Beijing. I think really the most important takeaway is that the talks happened. They had, it seems, substantive talks about a range of issues, many on which Beijing and Washington disagree, and they went pretty harmoniously. So the major accomplishment is that it keeps things on a smooth track in the lead up to the Xi-Biden meeting next week. So it sort of foreshadows a potentially positive meeting there as well.
Okay.
And that's pretty important.
Yeah. I mean, it's much better than the alternative, of course. So, Chris, give us a sense of what the U.S. and China want from these exchanges. What would success look like for the U.S.? What would success look like for China?
Well, each side comes in with very different priorities, certain specific topics that each side wants to bring up. Just to name a couple examples, on the Chinese side, they're really concerned about the restrictions that the U.S. is trying to put on China to restrict their access to advanced technologies, either through export controls, outbound investment restrictions. They're looking to kind of get Washington to step back a little on those. They're also interested in ending the U.S. tariffs on all sorts of materials. And on the Washington side, the Biden administration is quite keen to re-up regular talks between the military on each side. Yeah. Additionally, they're looking for Beijing to help crack down on the fentanyl trade. And then there's a host of other economic issues that Yellen would have taken up with He Lifeng today. Also, go ahead.
Well, I'm just curious, Chris, because I mean, all of the things you laid out here, these are things that I think we've all been, and by we, I mean the royal we, have been negotiating now for a while here. Is there any sense or any chance that we are going to get any sort of resolution to any of those issues out of next week's meeting?
Well, the shorter answer is I really think no. But that doesn't make this a failure. U.S.-China relations have been, for a number of years now, on very tentative ground, on thin ice, you might say. And they're easily disrupted. Setbacks happen from relatively minor incidents that are blown up. I think what each side is eager to, and certainly the U.S. Treasury has shown a great willingness, to try to regularize talks on just a number of even mundane issues. Try to develop a certain familiarity between the two sides so that when certain incidents do occur, they can just continue talking about them and try to prevent those from becoming blown up into a more serious issue that disrupts overall relations. Yeah. So, and I think the rest of the world is also very keen to see these go smoothly. Yeah. I mean, this is the APEC summit, and one might say that, you know, we're ignoring the rest of the Asia Pacific. Well, the rest of Asia Pacific is very keen to see Beijing and Washington regularize their communications and show that they can more reasonably get past incidents where there is great disagreement.
Well, we certainly heard that publicly from some nations, not all APEC nations, but certainly from names like Indonesia, Malaysia, and I think Vietnam has also spoken publicly about the need for that. I guess the question, though, is as well, I understand why some of those countries want to see U.S. and China relations improve here, but there are also some other sticking points when it comes to other APEC members, including Canada, for that matter, and South Korea.
There certainly are. They have their own particular thorny relationships with Beijing. I don't think it serves them, though, for the U.S. to be in a constant posture of conflict with Beijing. So as much as those countries have their own sticking points with Beijing, I think they're eager for the two large superpowers to be on better terms so that those things can be addressed. I think it helps address them more easily.
All right. All right, Chris, always great to talk to you. Chris Condon, our man down in Washington here, a big meeting set to unfold over the weekend and into next week out in San Francisco, the APEC summit here in the U.S., where we are expected to get a face-to-face meeting between President Joe Biden and Chinese President Xi Jinping on November 15th. Coming up here on the big program, a conversation with Catharine Bond-Hill, former president of Vassar College. We're going to get her thoughts on the college admission process in the wake of that big Supreme Court ruling earlier this year against affirmative action. That's coming up here on The Close. This is Bloomberg.
Spare a thought for high school seniors and their families because the college application season is currently underway. And with the Supreme Court's reversal on affirmative action, schools need to reconsider their policies when reviewing candidates. So the question now is, how do you build a diverse class while complying with the ruling? Joining us now to help answer that question, Catharine Bond-Hill, also known as Cappy, is the former president of Vassar College, and she is the current managing director at Ithaka S&R. Thank you for joining us here today, Cappy.
Really happy to be here. Thank you for having me.
From the outside, and as a parent, full disclosure, the answer seems to be that you put the onus on the applicant. They have to explain and discuss their race through essays. They need to explain themselves more. Take us inside. What are college admissions teams doing differently now because of the ruling?
I think with the Supreme Court ruling that's made, taking race into account in the admissions process at these selective schools, it's important to recognize this is a very small number of schools that actually...
But the ones that our audience cares about.
Absolutely. Those are the ones, the really highly selective ones that everybody's trying to get into and will only admit like 1 out of 5 or 10 of the applicants, if you're lucky. I think the main thing that schools are doing is taking a look at alternatives, and in particular, looking at income as a different way of looking for diversity in their student bodies. So rather than affirmative action based on race, it can be look for a socioeconomically diverse student body. And then, along with that, look at any processes that you're using that essentially privilege higher income kids so that lower income kids can also have a shot at getting in.
Are you talking about things like athlete recruiting, early decision, legacy preferences?
So early decision, legacy athletes would all be admissions procedures that have come to be known to privilege higher income white students. Mm-hmm. So schools are taking a look at that. Now, you can have all of those kinds of admissions processes and still recruit a diverse student body if you put an emphasis on doing that, going out and looking for lower income, more diverse students.
But is there need to change some of those other practices that we just referenced? And if so, what would prompt colleges to actually do something about it?
Again, I think the main thing to do is that you go out and you look for lower income students who are, in America, more diverse. And what you need to do that is allocate a lot of resources to need-based financial aid. So at Vassar, we increased the share of Pell Grant recipients who are lower income students. Again, a greater representation of underrepresented minority students. And we did that by allocating resources to need-based financial aid, while still sustaining legacy and early decision admits.
So you led Vassar from 2006 to 2016, and you talk about reinstating need-blind admissions. There obviously had to be trade-offs along the way in making more financial aid available. And we're talking grants, not loans, to lower-income students. What were the specific trade-offs? Because I remember some reporting on not as great food, for instance.
Yes, I thought our food was just fine, but it did mean that there were things we couldn't spend resources on. More faculty, smaller classes, and that's the real challenge for these institutions, because if you spend more money on need-based financial aid, you don't have it to spend on other things, and those other things can help you attract the share of your student body that are full-pay students. And that's important to your revenue stream, because all of these schools are counting on a certain amount of tuition revenue from their students.
You talk about things that schools spend a lot of money on, buildings, amenities, more administrators. It feels like Like other industries, higher education relied on easy credit for a number of years to expand. Now that rates are higher for longer and there's geopolitical tensions that may reduce the appeal of U.S. schools to some constituencies, like overseas Chinese students, how do you see colleges responding to that? What adjustments do they make?
You know, I think different schools are in very different positions. There are many schools who are, many of these very selective schools are just fine. And they will make some decisions on the margins. As they look for a more diverse student body, they'll be reallocating some money on the margin to need-based financial aid. For other schools that are having a harder time filling the classes, they're going to have to make some harder decisions about how to balance their budget. A lot of schools are facing enrollment challenges, as you mentioned, not just reduction in international students, but also this enrollment cliff that's coming in a couple of years.
Because of demographics. The cost to attend Vassar, $85,220 annually right now. As a trained economist and, of course, a former college president, this is going to be an obvious question, but is there any way a school might reduce its tuition or lower the cost and not exercise their pricing power?
So the problem with that is that if you lower your tuition or the full sticker price, given that the institution is meeting need with financial aid, the students that benefit are the high-income students. And they're lining up to attend these selective schools. So that would actually reduce net revenue at these institutions rather than increase it. I think for some schools that are giving need-based financial aid to almost all of their students, the idea of just lowering the sticker price makes sense. And that's a tuition reset that some schools are practicing. But it's not the ones that your audience are trying to get into.
Agreed.
So,
it is going to be Veterans Day tomorrow, and another way of expanding access to higher education, of course, is to admit more veterans, those who served. While this is happening, one thing you've noted is that it's happening at schools more often where the graduation rate isn't very high. Why is that?
Well, I think there are a couple of reasons. So there are about 5 million veterans out there who are eligible for the GI Bill benefits. They've often accumulated some credits while they were in the military, or when they immediately get out, they often go to their home area and enlist and enroll in a community college and get a couple of credits. And they want those credits to count. And the really selective schools are not great at admitting transfers and recognizing those credits. So it's a question, it's partly an issue of convincing veterans that these selective schools with these high graduation rates are a great option for them, and also convincing those schools that the veterans are a great source of interesting students for those institutions.
There's one way to add diversity, right? I mean,
absolutely.
I don't want to say check off a lot of boxes, but you accomplish a lot of things.
And veterans tend to be more racially diverse, and they tend to come from first-generation families, so they can add diversity.
Kathy, thank you so much. I've been speaking with Catharine Bond-Hill. She's the former president of Vassar College and current managing director at Ithaka SNR. Coming up, our Next Up series continues. Purva Gupta joins us next. This is The Close.
The week is over for U.S. financial markets, and a lot of traders and investors out there are really wiping their brow. We started off here with a 3-day rally, but it was a very tepid rally over those 3 days. We had the big sell-off on Thursday, but today that was followed by a big rally, and it was the most meaningful rally that we've had in quite some time. 1.6% gain on the S&P 500. Without that, the S&P 500 would have been down on a weekly basis, but instead it's up on a weekly basis by about 1.3%. You saw similar moves on the NASDAQ here, and more importantly, a test to the upside now of some key technical levels that suggest that maybe, just maybe, there is enough momentum to keep this rally going. Of course, a lot will depend on where yields go next. They did move higher on the week, and that is something that is going to be a concern for a lot of folks out there. We're back to 5% on the 2-year yield. The big question is whether investors and, more importantly, traders can live with it.
And of course, one stock that we've been watching, something we highlighted yesterday for you when it came out with earnings, and today as it continues to fall, is Trade Desk. The shares took a big hit after the digital ad platform warned about its revenue outlook. The news really left investors reeling and feeling uncertain about how social media companies like Snap and Pinterest would fare in this current environment. For more, let's bring in Bloomberg's Aisha Counts in San Francisco. Aisha, the thing that's bugging investors right now and that scared investors is this weakness in the ad market. Can you give us a sense of what the company told us about whether this weakness is temporary or more sustained?
Yeah, so in their earnings call, Trade Desk CEO said that it was mostly due to certain verticals. So if you think about automotive and the media and entertainment industry or things like consumer electronics, certain verticals, and particularly industries that have been impacted by strikes. So CEO Jeff Green specifically called out strikes that have happened in the automotive industry and media and entertainment. They started to see a little bit of a slowdown in mid-October. They said spending has since stabilized as of this month, but it's still something that they're watching. That's going to be challenging in the couple months to come. And then, of course, the war in Israel and Gaza is another factor in all this.
Well, I am curious, too, about another thing in addition to the strikes with regards to affecting automotive spending. There was some interesting commentary about sort of consumer electronics. And I'm curious as to what the reason was that the trade desk gave for softness on that side of the coin.
Yeah, I thought that was interesting as well, right? They specifically called out like mobile phones and cell phones, and they didn't dive into too much detail into why specifically that was. But I did think that was interesting as well, right? Why certain verticals may be pulling back in different ways as in others. And again, I think part of it is it's just this very volatile sort of macroeconomic environment that we're in and heading into. And I think it's really just impacting different industries in very, very different ways. And so they didn't go into too much detail around that, but I thought that was interesting as well.
Did they give any sense here as to how long this is going to play out? Is this some sort of cycle where we're going to sort of work through this and then we sort of revert back to, I guess, some sense of normalcy? Or are we talking about major changes here in just how ad spends go?
I mean, they seem pretty optimistic. They said they felt like the business is strong and sales are strong, and they've inked some new partnerships with different companies. And so they seem to feel like this was very transitory. They called it this sort of transitory cautiousness that they're seeing from advertisers. So they seem fairly optimistic. I think what was so jarring is that if we were talking, 2-3 weeks ago, right off the heels of companies like Meta, Snap, and Pinterest beating expectations in some cases by a lot, it sort of felt like, okay, that the digital ad rebound is back, and then you have a trade desk, right? And so I think that it was a little bit jarring for investors.
Yeah, definitely. That's confusing for investors as well. Aisha, did anyone talk about political advertising and how that might be something that's supportive to the market next year?
So if I think back to Meta's earnings calls, they did talk a little bit about political ad spend, for example. They said it wasn't going to be a huge, significant piece of spend for them, which I thought was interesting. And then, of course, we've seen a lot of these companies sort of change their policies around whether they want to allow political advertising. AI is something that's come up. But like for Meta specifically, as an example, they said it wasn't going to be a huge vertical for them.
All right, Aisha counts out there in San Francisco, a closer look at some of the data that we got out of Trade Desk and I guess some of the potential impact on advertising spending and AI. We're going to use that as a segue into our next segment, and our next segment is Next Up, where we highlight the entrepreneurs and trendsetters moving the needle in the markets, in technology, and in the venture capital space. And today we are focusing in on artificial intelligence and some of the companies that are finding ways to really not only tap into that technology, but let's just face it, make it actually useful for people. You're seeing that now in the fashion space. A company called Lily AI hopes to bolster the use of generative AI in the retail space. One of the co-founders of that company, Purva Gupta, is joining us right now. She is the co-founder and CEO over there at Lily AI, and she joins us from our San Francisco bureau. And Purva, let's start off first with the idea that your company really isn't new. It's been around since 2015, I believe, so that's long before the big media hype cycle around AI got started. But give us a sense here as to how much attention that you've gotten over the past year since that media hype cycle has started.
Absolutely, Romaine. We are absolutely having a moment, just like overall AI is having a moment globally. Like you said, I started this about 8 years back when AI was not hot, and I don't think even we started an AI company for the sake of AI. We have, from the very beginning, been focused on solving the consumer problem, and I think we were ahead of our time back then, 8 years back, and we had to be ahead of our time to be able to make a lot of progress over the last 8 years. And right now, it's ripe for showtime for us as we are working with some of the largest brands and retailers in the US and UK now. And so really enjoying all of the limelight that we're getting.
Well, let's talk about some of those brands. I mean, you came to my attention largely because of I don't know if you call it a chatbot or whatever it was on Bloomingdale's.com website here. And I saw a comment, I think it was either you made it or maybe it was your business partner who made it, this idea of sort of bridging the gap between what you call merchant speak and consumer speak. And the idea is that when I'm looking for something as a consumer here, I'm looking, I'm thinking, and I'm saying things in a way that aren't necessarily the way that Bloomingdale's, or at least the infrastructure behind it, talks.
Yeah, and so let me answer your question with an example here first. So the way that majority of brands and retailers and really merchants like to describe their products is with a lot of aspirational and very flowery copy. So something like midnight French terry at leisure. But you know what? When real people look for stuff, they are saying navy blue hoodie, right? And so there is this communication breakdown that's happening between the merchant speak and the consumer speak. That's why we all as consumers go through a lot of frustration because we're not able to find what we are looking for. It's not that they don't have it or we don't know. And so that's really what's happening here, where we're using AI to bridge that gap between the language that merchants are using so they can still keep running their businesses the way they would like to, and the language that consumers are using to find what they are looking for. And really here, the mission of Lily AI is to bring humanity to shopping so that, you know, the consumers can see their real selves in the shopping experience and focus on be who they want to be.
How do you make sure that your product, what you're basically partnering with these retailers, that the output, meaning the end result for the consumer is accurate in the sense that it's what that person is actually asking for? Because I'm sure, as you know, some of these new chatbots, I was on one with an airline, and it was like just talking in circles. I mean, it took me nowhere here. So how do you avoid that problem where when I'm looking for a very specific item here, that the output is going to be directly related to that item?
I love that question. So that's the big differentiator that we have at Lily AI versus a lot of other players. And now everybody is using AI, right? Like it's like electricity. Who's not using AI, right? So I think the fundamental difference here for specifically this space, like you mentioned, in retail and fashion, is accuracy. Like, are we able to provide the accurate consumer-centric attributes back to the brands and retailers so that what the consumer is looking for is actually able to, like, they can find what they're looking for? The way we do that is we've used a lot of discriminative AI over the last few years here, where what that means is we have trained it with very clean training data points. As you all know, your AI is as good as your training data.
Right.
So what we did that was different than what a lot of other people are doing today is we got specialists, domain experts that manually labeled a lot of the product catalog and created that clean training data. Lily today has the largest clean proprietary training data set in the world.
Yeah.
And so that's what was fed to our AI engines, which today are doing a phenomenal job of very accurate results. And this is the thing, accuracy is really important at the end of the day, especially when you're putting it in front of your consumer and they're deciding based on that. And so that's what we're all about. And we've used a few different suite of AI applications to be able to get to that accuracy goal.
We don't have a lot of time left. I am curious. I mean, you did just real recently, I just want to make sure I have this right. You did actually hire a new president, right, to kind of deal with some of these operational issues. And in addition to hiring him, I am curious, are you doing any sort of large mass staffing?
Absolutely. Because of the growth that we are going through, we are in a really good spot to get the next level talent. And so we're hiring across a lot of different types of roles and really getting ready for that scale, the hockey stick scale that's coming up for us next year. And so I'm really thrilled that we have such a fantastic C-suite already assembled, and we're getting ready for a lot of hiring as we get ready for massive scale next year.
All right, Purva, I have a feeling we're going to talk again soon. Really appreciate you taking time for us. Here
Thank you so much.
On our next up segment, Purva Gupta there. She is the co-founder and CEO over at startup Lily AI. Scarlet?
All right, we did get some breaking news just now, late Friday. The United States outlook has been cut to negative from stable by Moody's. So the actual credit rating of the U.S. remains the same, and Moody's has affirmed that AAA rating, but it has downgraded the outlook. So I want to bring in Michael McKee, who, of course, is our go-to for all things economics and policy. Michael, this would be the last U.S. rating company that has kept the U.S. at AAA, correct?
That's correct. It was 2011 that S&P downgraded the U.S. during the budget problem that year, and then it was only a year ago that Fitch downgraded the U.S. Now, the question is, would Moody's doing it add anything to that? There's some question about whether it would matter all that much, in the sense that in some cases, portfolio managers wouldn't be allowed to own downgraded stocks, but downgrading to AA from AAA probably would not be a major issue. And then you go back to the 2011 experience, it had an immediate impact in the bond market that 2 days later was gone. So it's a black mark, but it probably doesn't mean a huge amount unless they actually do the downgrade, and then we'd have to see what effect it would have on bond yields.
I am curious, though, too. I mean, when you see these reports, Michael, and the idea that they're not necessarily talking about the fundamentals themselves. They're talking about political polarization. They're talking about the dysfunction in Washington as sort of the backdrop for why they're making the decisions to put these ratings on watch here. And we'd be remiss in not pointing out we're 1 week away from a budget deadline. The Speaker of the House is on his way to Europe instead of actually in Washington working on a deal, and we still don't have a bill on the table. So why should we not think that the Moody's, and for that matter, Fitch and S&P, will follow through?
Well, we don't have a direct warning from Fitch and S&P that they would go further than their downgrade that they've already done. But Moody's, certainly with a negative outlook, could take additional action if the U.S. were to have a government shutdown next week. Maybe this, it could be that Moody's is looking at this as sort of a warning shot over the bow of the USS Congress or something like that. The issue for the ratings companies is not for the U.S. the ability to pay. We've got a printing press. We have basically unlimited funds. We'll always pay our debts unless, obviously, a debt ceiling issue comes into it. But the U.S. can always pay. It's a question of would they pay, or would it be a messy situation, as Moody's sets out in its press release today. And that is why they would downgrade us, not in the sense that you're not going to get your money back, but that it is an issue for debtors that the U.S. And creditors that the U.S. would be having trouble.
I get that, too. And I mean, I'm just going through Moody's statements here because they're also looking long term, too. I mean, they're basically just saying, look, if there isn't some sort of resolution on these fiscal issues, I don't mean just the short term things that we have to deal with in the next week, but if there's not some sort of longer term shift in how we're approaching these annual budget deals, that there is a material potential for a material decline in the strength of our fiscal house.
It is interesting because when you get to the section on the long-term outlook, they do look at the federal interest payments relative to revenue and GDP and suggest that it is going to rise significantly to an unsustainable level, which helps make the argument that some people in Congress are making that they need to cut spending as soon as possible. And so this will probably be taken up by the Republicans as part of their battle cry in terms of that.
I'm sure it will.
We don't know. We don't know if it will, if we will actually reach those levels, because if the Fed cuts interest rates, then it won't be as bad. But it is something that they seem to be concerned about.
All right, concerned about here, I guess, though, the fact that the speaker is actually not in Washington, maybe they're not that concerned. Michael McKee, of course, our Bloomberg International and Economics Policy correspondent. We should just point out that the Republicans did say that they do plan to put out a budget plan over the weekend, though, and when the Speaker of the House gets back into the country, maybe they can try to vote on it. The United States credit rating outlook changed to negative from stable over at Moody's Investor Service. Meanwhile, when we come back here on the big program, a further discussion about AI with Nobel laureate Michael Spence. Stick with us. This is Bloomberg.
Welcome back to The Close. It's time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Weston, joins us as he does every day here, just ahead of your big program here in just about an hour's time. We were just having a conversation on The Close about artificial intelligence, which I'm sure you know is all the rage. And you had a chance to sit down with somebody who's a real pioneer in that space.
Yeah, Michael Spence, the Nobel Laureate in economics, and he wrote a piece with Joe Manica from Google. It's in Foreign Affairs. This issue of Foreign Affairs takes a somewhat different approach to it, saying we have a big productivity problem globally right now with the economy, and maybe AI can help us, but that's only if we make it broad enough. This is part of what he had to say.
The knowledge economy, when you think about it carefully, kind of runs through and across the entire economy. So even in what we think of as sectors that are sort of largely blue collar, there's a fair amount of knowledge, that goes into these things, skills, knowledge, and so on. I mean, take something like nursing. Nurses are pretty highly trained people. They have to respond in intelligent ways to the signals they get from, the equipment that patients are using and that they're looking after and so on. But yes, I mean, the CEO of Google, when asked, where is this going to have its immediate impact? It's going to be in the knowledge economy. But I think, we tend to think of that as sort of white collar work. And there's an element of truth in that, but I think it actually does run right across the entire economy. Maybe not to the same depth in every sector, but nevertheless, it's very broad-based.
Do we have a sense, and I understand this may not be determinate, I mean, that is to say it may differ based on what we do, but do we have a sense of the extent to which this generative AI will displace jobs? They will go away as opposed to transform jobs?
So, look, I mean, we're in a period of intense exploration and experimentation. So, people often say, that it's important to acknowledge, real uncertainty when you're in the early stages of this. And that's certainly characteristic of this. Having said that, James and our best guess is that generative AI is mainly, not exclusively, but mainly going to turn out to be, a powerful digital assistant.
One of the points you make in the paper is that, as I say, this is not predestined. To some extent, how this ends up depends upon us and what we decide to do about it. Explain to us about what you think needs to be done or should be done so that we get the most good out of generative AI. And as a subpoint, how much of that can be trusted to the markets as opposed to governments?
So, I think the markets and government and attitudes and biases, are all part of the mix. So I think the first order of business is to avoid what Eric Brynjolfsson calls in an influential paper, the Turing trap. So Alan Turing proposed that we evaluate progress with digital machines by using the following tests. Can we build a machine that interacts with a human and the human thinks that it's interacting with another human? It's a fairly small step, and this is common in the AI world, to evaluate progress in AI by determining how well machines do relative to human performance. So we do that in language recognition. We do it in image recognition, which is a huge breakthrough in the last 6-7 years. And we do it, with generative AI. Does the generative AI do better than the average human on the LSAT, the law school aptitude test? That's okay, but there's a very small step from that to thinking that, well, once the machine passes the human, why don't we get rid of the human? And that leads you to what you might call the automation bias. And that I think we do have to resist. And that's not government, that's not business, that's not any particular sector. It's just the way we think about it. So I think that's step one. Step two is, you can influence the direction of technology and development. And I think, with incentives and so on, and it should be influenced in the direction of collaboration and augmentation is the term that tends to be used in this world. And then third, we do not want, or with the way James and I thought of it, we don't want to repeat that pattern of, sort of high adoption rates and very low adoption rates that we saw in earlier rounds of digital, adoption. And so there, I think the government has a very distinct role to at least think carefully about programs and activities that, increase the likelihood of diffusion across the entire economy to small and medium-sized businesses. And for me as an economist, this is not just a nice to have or a distributional issue. If we believe there's a potential productivity surge for the entire economy, we're not going to get it. If we can count on the fingers of one hand the sectors that have moved ahead in using this. So I think it's important from a kind of macroeconomic performance point of view to think carefully about what we can do to maximize this, sort of accelerate the diffusion and adoption rates across the economy.
That was Michael Spence, Nobel laureate in economics and Stanford Business School Dean Emeritus. We'll hear more from Dr. Spence, as well as from Asani Beschloss of Rock Creek, and also Melissa Carney of the University of Maryland at 6 p.m. Eastern Time this evening on Bloomberg. Back to Romaine and Scarlet.
All right, thanks, David. I'm sure to check out Wall Street Week, 6 p.m. Tonight here. It's been a pretty wild week, Scarlet.
And that's just in the markets.
And that's just in the markets. And you kind of wonder what next week is going to hold. A lot of events that markets are going to have their eye on. And we're actually going to start over the weekend. It's Singles Day in China. Did you know that?
November 11th. Yeah. That's because the number one looks like a single branch, which in Chinese is a shorthand for a single guy.
I never knew that.
Yeah, because if you have a family, then you grow branches.
All right, well, this is a big online shopping event. We'll wait to see how those numbers play out. But meanwhile, back here in the U.S., we're going to get some hard data out of a lot of retailers here, starting with Home Depot.
You've got Home Depot, you've got Target, you've got Walmart, you've got Alibaba, which, of course, invented the Singles Day holiday. You've got Ross Stores, you've got TJX. A big question is how much people are spending in advance of the holidays.
Yeah, and I think so. I mean, and we talk about sort of this idea, are the issues just at the luxury end that we've seen, or is this really going to be across the board? You're going to see the middle class and you're going to see the lower end consumers also sort of cutting back on some of their spending here. And that actually dovetails with the next big batch of inflation data that we get, including the big CPI number on Tuesday.
Yeah, and when you look at the year-over-year numbers, you're looking at 3.3% for the headline number, and when you back out food and energy, it'll be 4.1%. Not where the Fed wants it to be.
Yeah, not really here, but I mean, the trajectory has still been down. I mean, it has been a little bit of bumpy along the way, and I thought the comments that Jay Powell's kind of saying, look, we knew it was going to be hard. I guess that last percent, that last mile, if you will, is always going to be the roughest. And then, of course, a big meeting here in the U.S. China again. This time, President Biden and Xi Jinping set to meet for the first time in about a year.
Yeah, they're going to meet in San Francisco, which, of course, has its own issues. So the Chinese media has been making a lot of hay with that, pointing out the American way not really working out so well for the big cities. But, of course, the big issue is how they discuss trade, how they discuss Taiwan, how they discussing even more.
But you said the key word there, discussing. They're talking.
Yes.
And that's a good thing. And we've been talking a lot about Yellen and her meeting with her counterpart earlier today and yesterday. I mean, that's a good thing, right? Because I feel like a few months ago, nobody was talking.
Yeah, well, it had to come to this, where they're finally talking about talking more.
And then, of course, 1 week from now, we have that deadline for the U.S. Congress to actually pass a budget. What happens if we don't, Scarlet?
We've been here before, haven't we?
All right. Well, Moody's has a few thoughts about that. The Treasury responding, saying, hey, nothing to worry about here. Thanks for watching us here on The Close. Scarlet and I will be back next week. Meanwhile, stick around. Balance of Power is coming up next. And after that, Wall Street Week. This is Bloomberg.